deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Recession is uncomfortably high. I don't like it where it is. I don't think it's a done deal. I don't think it's 100%. The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck because it no longer has time.
The brilliant Mohammed Al-Arian, Bloomberg opinion columnist and president of Queen's College, Cambridge. If you're just tuning in, futures recovering a little bit on the equity market. The S&P 500 down by 0.6%. The underperformance, of course, on the NASDAQ, where the big weightings are taken by big tech, and big tech disappointed after the close yesterday. We'll get to that in just a moment. Yields are lower by 4 basis points on a 10-year, just north of 4%. The dollar is a whole lot weaker. Euro dollar with a 1 in front of it for the first time in a long time. Above parity, euro dollar positive about 5 or 0.6%. Lisa, going into the ECB tomorrow, and I said this a few times this week, I never thought we'd see a week where the PMIs were in the 40s and we'd see the ECB, never mind hiking, but hiking 75 basis points.
And how far away are we from politicians pushing back in a much more meaningful way? You got hints of that in the U.S. You also got hints of that from the Italian prime minister. How much are they going to start pushing back and saying, guys, maybe you don't need to do this. It's not the right way to go about reducing inflation.
Hints of that. I think you're being kind. Punchbowl reporting yesterday
okay, fair.
that the Senate Banking Committee chair, Sherrod Brown, has written a letter to Chairman Powell that said we must avoid having our short-term advances and strong labor market overwhelmed by the consequences of aggressive monetary actions to decrease inflation, especially when the Fed's actions do not address its main drivers. Chairman Powell in Jackson Hole talked about pain. I keep going back to that speech in Jackson Hole at the end of August. He talked about the amount of pain we'd have to go through because the greater pain was not dealing with it. Well, we're about to see some of that pain and potentially in the labor market, and the political pushback you're going to get is starting to build down in Washington.
But it's on the margins, right? Yes, we heard that from Sherrod Brown. But how much is this becoming the mainstream, this sort of drumbeat? Is this just basically ahead of the midterms to try to shift the blame? Or is this something that's sincere, where people think that the Fed is actually going too fast at a time when inflation is the highest that we've seen in 40 years? I'm not sure about that yet.
I think if it's a politician, it's definitely politics.
Yeah.
But I imagine it's also a bit of both.
Yeah, I think you're
that
right.
That concern that Sherrod Brown has is a concern that many economists on this program have too.
I would agree.
We need to talk about tech earnings. After the close, we get Facebook. We've had the ad spend disappoint over at Snap. It's disappointed over at Google. We get Twitter potentially in the next hour or so. Mandeep Singh joins us right now, Senior Technology Analyst for Bloomberg Intelligence. Mandeep, what are you learning about ad spend at some of these big tech companies?
Yeah, I think Alphabet results show that not everything was priced in. You know, we talk about negative revisions and how we've seen, Snap top line being revised 30% for next year. In the case of Alphabet, the estimates had come down by 10%, but guess what? They came out with a disappointing print, and the guidance doesn't seem to be very optimistic. So right now you have a combination of slowing top line growth, and I think the part that was the most disappointing was on the margin side. Their cost structure continues to go out of control. They talked about lowering headcount for the next quarter by 50%, but still, it's just, the fixed costs continue to rise, and that is what is showing up in Alphabet's margins, which were down almost 300 basis points below consensus expectations.
Let's pause. We've heard a lot of tech layoffs talk, and there's questions about how much more they have to go. Mandeep, are you saying that there need to be very deep cuts to Google's staff in order to become more efficient the way that stock investors would like to see?
I think it's more about why are they growing headcount by 25%? When they could see that the top line was decelerating. And granted, there was some pull forward last year. I mean, in the same quarter last year, they grew 41%. Tough comp, get it. But at the same time, you could see the trend line in terms of, the advertisers pausing and, slowing down. Why did they have to grow the headcount by 25%? And I think that is what is baffling in terms of how they manage the cost structure. I mean, this is not the first downturn that Alphabet is going through. So clearly, I think some answers around what is it that will be the next leg of growth, because they talk about cloud and how, that will be the next leg of growth. Clearly, that's dilutive to the overall margins. And I think in the case of YouTube, there was a marked deceleration. So the headcount growth clearly is concerning when it comes to Alphabet.
But this isn't just an ad spend issue, right? Because we also got Microsoft, and those shares are also falling because of the disappointing forecast for the Azure, for the cloud computing unit. How much does this indicate a broader pullback in even some of the services that people thought as essential, and in a structural shift higher that's going to lead to further and deeper cuts among the big tech complex?
I think in the case of cloud, you're going to see a digestion phase. Clearly, we saw above trend growth when it comes to digital transformation and just IT spending overall. So you're going to see a pause. But in terms of secular growth in cloud, nothing is changing. We still think as cloud will grow, high teens, and it's a pretty large addressable market at this point of time, 400 billion plus. So I think in the case of Microsoft, especially on the cloud side, that will be more like a quarter or two growth normalization more than anything else. But ad spend, you really have to think about, is search saturated? And granted, YouTube is going to grow, at a healthy 25-30% clip once we come out of this downturn. But the real concern is around the search cash cow and, how much room does Google have to grow over there?
Google, Alphabet, I hate calling it Alphabet, down hard in the pre-market. We're down about 5 or 6 percentage points. Microsoft, a similar move lower. A little bit later, Mandeep, we get Meta. I hate calling it Meta too. I just can't get used to this.
I know, everybody.
Facebook. Mandeep, we get Facebook after the close a little bit later. We've talked a lot about how they have different clients, different customers when it comes to ad spend. Mandeep, the price of the story, it's been battered this year. You know that well. What are you expecting for Facebook a little bit later?
More pain, more estimate cuts post earnings. And look, I think in the case of Facebook, you're going to see ad pricing compression. I mean, clearly they are the worst hit when it comes to the Apple's privacy changes. And the fact that they're not diversified, in the case of Alphabet, at least you've got, top line diversification, although it's dilutive to margins. In the case of Facebook, this is 98%, advertising revenue. And people are complaining about, their Oculus Reality Lab spend, how it's a big drag on free cash flow. All these companies have to think about capital return. Even Alphabet didn't mention a word about capital returns, buybacks, and, thinking about why would a shareholder be in these companies if they're not, getting that return, because the share count isn't going down and the margins are going down, free cash flow margins are going down. So I think that is the answer that Facebook has to think about, but clearly there will be a lot of top line pressure in the print.
It's a different world. Mandeep, let's catch up tomorrow after we've all had a little look at Facebook after the close a little bit later. Meta is down by about 4%. Google is down by 5.9% in early trading. And Lisa, I think what was interesting about the earnings yesterday is just the broad sweep of things. It was IT budgets, it was digital spend, it was machinery, industry, autos, the concerns all over the place after the close yesterday.
Everybody's saying that there's a lot of just differentiation within the tech complex. Kind of got a dose of cold water on that, because all the differentiation is being beaten up in different ways. How much is this going to lead to further job cuts in the tech world? And that's really going to be the theme, I think, throughout all of these earnings.
Those tech names dragging down the S&P 500. We're down by about 0.7% on the S&P. There is a rally in the Treasury market. Treasury yields are lower on a 10-year in America by 4 basis points. And this dollar is a whole lot weaker. From New York City, this is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price. And then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We will never break. We will never break. Build on a foundation strong enough to stay.
volatility, the fear, the capitulation has really not been there yet.
We do have a recession penciled in. I suspect it may not be as bad as some of the more extreme forecasts that are out there.
Have the markets seen their bottom? We're all talking about the risk of recession, but markets still, to me, don't have it priced in.
I think it's very hard to see something that's going to be smooth landing in any way.
The financial strains are going to become more severe because right now the Fed is on the way to go from 3 towards 5%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
3 days of gains colliding with negative news after the close yesterday. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. TK back with us tomorrow. Equity futures down 0.6% on the S&P. We've had 3 big days of gains, Bramo, and we get some bad earnings, I would say, after the close.
Yeah, especially given that this is in the big tech world and there already have been such beaten up expectations, considering that they'd failed to meet that bar, raises some big concerns for some of the other tech earnings that we get today and tomorrow.
It's earnings from Google that disappoint. It's the guidance from Microsoft that disappoints. And this was always going to be about the guidance, never mind 3Q. It's tell us what you think for 4Q and beyond. Have we got a decent picture of that just yet from these big names?
It's not good. I mean, and I'd throw Texas Instruments in there as well, and I know we don't talk about them as much, but as you pointed out, this is a broader swath of the tech sphere. This isn't just the small electronics and things like iPhones or other things. These are, just a broad industrial complex, as you point out. So how can this be positive, especially when it's broad-based? It's not just ad spend. It's also with respect to the investment in the cloud.
It's ad spend, it's IT investment. It's beyond that, it's machinery, it's industry. Let's talk about house price growth as well. That data point, I have to say, typically at 9 a.m., 30 minutes away from the opening bound, that data comes out, and for years I would just ignore it.
No one cares.
For years. Right. Now all of a sudden it moves the bond market, it moves equities too.
What you saw is the fastest deceleration in the increase year over year in home prices ever. And just now we're seeing that 30-year fixed mortgage rates are topping 7% for the first time in 20 years, is according to MBA data. Clearly, high mortgage rates are putting a huge chill on housing. How much does this actually bleed into the CPI? People are actually excited to see this because they think, oh, this is great. This means a deceleration in inflation. And other people come out and they say, actually, prices are still rising. It's going to take a while to go into CPI. Oh, and guess what? Wages may also be increasing at a faster pace. We'll wait to see that on Friday with the ECI.
Fed decision coming up next week. The ECB tomorrow. The Bank of England as well next Thursday. We'll get to the UK in just a moment. Equity futures right now on the S&P down 0.6%. On the Nasdaq, a whole lot lower off the back of some disappointed tech numbers. More Facebook tech after the close. Bramo's going to go through that for you in just a moment. Yields are lower in the bond market on a 10-year by 4 basis points, just north of 4% on a 10-year Treasury. Big moves in the FX market, though. Tons of dollar weakness against the euro dollar, positive 0.6%. I'm struggling to get used to parity now, Lisa, but we're back above parity on euro dollar.
Do you think that you have to get used to it?
I've got no idea.
I mean, that's really the question. Can we get used to this? Is this dollar weakness a story that is more pervasive, having to do with the rest of the world, or is this an issue of arguably perhaps intervention by some major Asian banks? So what's coming up, just in moments, we're going to hear from UK Prime Minister Rishi Sunak. He's taking his first Prime Minister questions. How much can he give some insight into what that plan will be that they plan to unleash on November 17th? They want to get a full assessment of it. That might be a good thing in terms of prudence. However, it does, as John was mentioning, put the Bank of England in a little bit of a difficult situation. We are seeing a slight bit of pound strength. 10 a.m., this may be the moment of the day, the Bank of Canada rate decision. They tend to be the front runner. If they decelerate the pace of their rate hikes, how much does that set the tone for a step down at the Federal Reserve? And I'm sure that people are like, oh, why are you doing that? But I think that that's actually feasible, right? They have set the tone.
Sure. We'll see what they do. I mean, I'm laughing because I find this step down stuff just ridiculous.
I know that you're laughing, but and
this
a lot
has
of
been a
people
conversation for about a month, maybe longer.
I know.
In fact, maybe 2 months.
All right. But I think people are getting hopeful that perhaps we're getting to that point and maybe we'll even get some market disruption. And the Meta, as we were talking about after the bell, Facebook, how much do they confirm this feeling of advertising really decelerating? And how much do they sort of add to the gloom that we're hearing? And what point does this lead to layoffs? And I really, that's what I'm going to be listening for. How much is Facebook going to cut its staff And how much is this really setting the tone for others?
How much is Twitter going to cut its staff once Elon Musk gets hold of it? That's a good question.
This is, so evidently he's going to buy it, right? Friday he's going to close.
We'll see.
Calling on the banks. You're skeptical?
No, I just think, I remain open-minded about this story.
You're not alone. Because
it's got this message on the Bloomberg. It said, imagine a world without an obsession with the must-Twitter deal, UK politics, and Fed speaker diarrhea. What would we talk about?
The weather, how beautiful the world is.
Joining us around the table to talk about the weather and how beautiful the world is Anila Daya, the Global Equities Senior Research Analyst over at Invesco. And Anila, great to catch up with you. We've had a big rally in the last 3 days. We often do this, but I've got to ask the question, how do you know the difference between a bear market rally and something more durable?
Good question, Jonathan. And the answer is you really don't until it's well behind you. But here are a few things that we do know. We know that investors are obviously skittish as the Fed pulls away the punch bowl of easy money, and that's going to lead to a lot of mispricing and uncertainty as people position for this new world. And in these situations, historically, you've always seen that when we're through the worst, the biggest gains of the next leg of the cycle usually come in the first third of the cycle, when the fundamentals are still deteriorating, when there's still gloom and doom, when sentiment is still negative. So we know that whether this is a bear market rally or the real deal, you don't want to be sitting it out till someone blows the all clear whistle. And so we are still judiciously bullish on equities. There's a lot of long-term forces to be excited about once you look beyond the short-term noise and all the headwinds that you've been talking about. Equities ultimately are a claim on human progress, and there are so many forces pushing GDP higher over the next 5, 10, whatever years that we believe that, mass affluence, new technology, aging, restructuring, these big forces that we call mantra will continue to drive equities and compound them over any long term.
What did you say? A claim on human dominance or progress?
Human progress, yeah.
Do I really want to buy into the claim on human progress right
you
now?
clearly
Do you feel
have
like
doubts
that?
about
I'm just
human progress,
I'm just
don't
wondering. I'm not going to get into that. We don't have to go existential. I am curious, though, of whether the recent earnings cause you any questions or pause about what kind of claim on human progress we have at this moment.
Well, existentially speaking, Lisa, just for a second, the one trait that has never ever worked in the history of mankind is to be short human progress. That has never worked, right? And as Jeff Bezos said, since we're talking tech, human beings have an immense ability to innovate themselves out of a hole. So moving on from, highfalutin human progress to what happened yesterday, it's, all the headlines that you've put up this morning, right? It's not positive, it's not a sure thing, but we're not having any data points here that suggest the bottom is falling out and that things are effectively negative. We're seeing a slowdown in budgets, we're seeing more scrutiny, decisions are being pushed out. It's like turbulence on an airplane. Put on your seatbelts, but the oxygen masks aren't dropping yet.
So are you buying big tech?
We are always buying any stream of cash flows where the net present value is higher than the stock price. And with big tech, the larger case for tech or these stocks is extraordinary, right? I mean, we're living in a world deluged with data. These business models are a thing of beauty. They're low capital intensity, they're very high returns on equity. Investors would be unwise to ignore big tech. But at the same time, in light of the environment that we've been talking about, you want to be judicious. You want to be in places that have a strong position on the value chain, that have some kind of pricing power and margin sustainability, clean balance sheets, and copious amounts of free cash flow.
Everything you've said, we could have said at the start of the year, couldn't we?
We could have, but the valuations would be a lot higher. So
Sure, but that's my point. Everything you've said is true and could have been true at the start of the year, and we're down by more than 20% on the NASDAQ. Haven't we got to reapproach how much these companies are worth, the multiple we want to pay on them? Now we've just blown up 10 years worth of central banks boosting bond buying, leaving rates at zero, seeing negative rates elsewhere. Isn't that the ultimate challenge for us now, to work out the price of the risk-free asset and the price of risk? And for me, that's an ongoing process. Isn't that an ongoing process for you and the team as well?
Yeah, so the one difference between the beginning of the year and now is that valuations are significantly different, right? So that changes the entire calculus for an equity investor, because at some point, everything at a price, and at some point when things do get priced in, the risk reward becomes asymmetric. So on a case-by-case basis, some things are starting to look attractive. The part that I think we've had a, sort of a sobering moment on, people who played on the speculative end of the spectrum, the Jam Tomorrow stories where it was all about taking in free money, growing like gangbusters, and having some indeterminate business model manifest at some future date. That story's definitely gone out the window.
Ananya, wonderful to catch up with you. Let's do this again.
Thank you.
Ananya Ladai there of Invesco. On a tough day for equities after a big 3 days of gains on the S&P 500. I say tough, we're down by 0.7%, not a major move. Bit lower on the NASDAQ. We're going to catch up with the man with the crystal ball. It's Mike Wilson of Morgan Stanley, the CIO and Chief US Equity Strategist. We'll do that in the next hour. And this is a man that's called this market pretty well over the last year. And just last week came out and said you could get a short-term technical rally. And Lisa, guess what we got? A very big week of gains.
Yeah, what did he say? 4,200, but we could get up to 4,000.
Those kind of levels,
those
through
kinds of
4K.
levels. So we're getting there, and then bottom falls out. But you know, I like Ananya's idea of a claim on human progress,
I saw you making
a thing
notes.
of beauty. I mean, it's like keeps me going after Nouriel Roubini yesterday. But this issue right now of how much do we have to price in a new valuation structure, as you raised, is the question. And it's unknown because people don't understand what the end point is and what this inflationary regime is. And it's a really important point that underpins a lot of the volatility we've been seeing.
Still trying to figure that out, trying to figure out what happens in the UK as well. We know that we'll get a fiscal statement on November 17th. We're reporting, Lisa, some of the ideas that are coming about from the UK government going into that fiscal statement. The UK is seeking to plug a £35 billion fiscal hole on November 17th, according to officials. The Treasury has drawn up 104 options to cut spending.
104?
104. It's very specific stuff, isn't
Exactly, I love it.
But this is going to be painful.
It's going to.
At a time where we have high prices, a cost of living crisis, and we're going to see some austerity from the British government.
And how much is Rishi Sunak, who has been in the business world and is a wealthy individual, how much will he target some of the businesses with taxes and things that really Liz Truss tried to move away from? How much does he double down on that in order to plug that gap?
Do you know why Tom took the day off? To watch PMQs. TK's messaging me right now, enjoying PMQs. Question time with the Prime Minister, and Lizzie Burden's going to give us some insight to what they're talking about.
I think he's practicing. He's role playing with jury duty. You know, he's trying to figure out. He's like, you know, in the court.
I've actually got no idea what
banging,
it's up to.
Banging on the table.
Futures on the S&P down 0.7%. We'll catch up with Lizzie over in Westminster in just a moment. The Prime Minister in the UK, spending does need to be paid for. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New British Prime Minister Rishi Sunak has delayed an economic strategy announcement that was due to be delivered on Monday. It will now be released on November 17th. According to Sunak's office, he wants more time to make the, quote, right decisions on managing the British economy.
Our number one priority is economic stability and restoring confidence that the United Kingdom is a country that pays its way.
The government wants to close a fiscal gap of more than $40 billion. Bloomberg's learned that Elon Musk is promising to close the acquisition of Twitter by Friday. Musk made the pledge in a video conference call with bankers helping fund the deal. They're providing $13 billion in debt financing. The European Union's executive arm will lay out plans to drastically cut pollution levels across the bloc today. That could potentially eliminate more than 70% of the 300,000 premature deaths annually over the next decade. Overhauling air pollution will bring the EU closer to guidelines laid out by the World Health Organization. And Deutsche Bank is signaling that it may exceed its full-year revenue target. The German bank's traders kept taking business from rivals, and rising interest rates fuel income from lending. Deutsche Bank saw fixed income trading jump 38% in the third quarter, beating most of the U.S. investment banks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. Show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Multi-trillion-dollar industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Earnings season is here.
The earnings are starting to pour in.
The numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going to cross the wire.
A big beat. Stock is up more than 8%.
Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Prime Minister and I have decided that it is prudent to make that statement on the 17th of November, when it will be upgraded to a full autumn statement. And I've discussed this last night with the Governor of the Bank of England. He understands the reasons for doing that, and I'll continue to work very closely with him.
Over to you, Governor Bailey. The Bank of England decision next Thursday. That was Chancellor Jeremy Hunt in the UK. The Prime Minister, Rishi Sunak, declining to say just moments ago in Parliament if benefits will rise with inflation. Bramo, we're going to find out what these spending plans look like in about a month from now, and this Bank of England's got to anticipate that with their decision next week.
And the likelihood is they will probably strip back a lot of the benefits. They probably won't spend as much. I mean, that's basically what needs to happen, saying that you have to spend for, you have to cover some of what you spend. I do wonder, though, how much the Bank of England and Andrew Bailey is in the hot seat. Did you see this column from former Fed official Kocha Lakota coming out and basically saying that markets didn't oust trusts? It was the Bank of England that did, by not plugging the gap in the regulatory hole that was some of these pension plans, the pension schemes. How much is this going to be a political issue for Andrew Bailey to try to do the least damage at this next meeting?
Look, I know it's a sport to beat up on central banks. I'm happy to participate. You know that. Of course, of course. Made a career of doing that.
I'm not saying this. I'm saying
when it
that
comes
you
to
said
this Bank of England,
Yes,
I
carry
have
on.
a certain just a little dose of sympathy. I think they were incredibly concerned about contributing to fiscal dominance or perceived fiscal dominance. And if they had done so, we would have had a much, much bigger problem in the United Kingdom. Having said that, they do have responsibility to make sure that financial instability doesn't make things even worse. And there was clearly a financial instability concern in the United Kingdom.
I would argue that it is getting less and less clear how central bankers remove themselves from the political discourse, how they remove themselves from offering up either some fiscal discipline or offering up, some sort of fiscal amenability to basically say, you guys can do whatever you want, because at this moment, their policies are directly moving in tandem with what's going on fiscally. So they can't ignore it.
This is the irony of
Yes.
it. If you try to avoid the politics, you become a part of the politics anyway.
There's no way to avoid it. That's another way of saying it. And that's what we're seeing. And so, at what point does Andrew Bailey try to stay out of politics at this tenuous moment with a rate decision that's really important from an economic perspective with inflation?
But you've now got governments worldwide, including the central banks, in the politics. We've talked about this operational independence for a long time in developed markets, but look at what's happening in the United States. We've had Senator Warren, we'd had Senator Sanders, and now we've got the Senate Banking Committee Chair, Sherrod Brown, writing a letter to Chairman Powell, according to Punchbowl News just yesterday, complaining about rate hikes. We're going to see so much more of this, so much more of this. And what's amazing to me is that the people in power, did you hear much complaints about zero rates at the Federal Reserve when those people were in power taking advantage of it? And this is the other edge of that sword.
Right. Where is the political responsibility at a time when you need to come up with long-term plans and you've got short-term election cycles, and what's expedient from the election cycle might not be what's expedient for the economy?
You've got problems worldwide right now. Let's talk about some of them with Bloomberg's Lizzie Burden over at Westminster. Lizzie, you've been hearing the Prime Minister speaking in Parliament in the last 15 minutes or so. What did you hear?
Well, John, if you thought that the grown-ups were back in the room, maybe think again, because Rishi Sunak might have pressed the reset button, but it sounded a lot like the responses that we heard at the dispatch box as his predecessors. Keir Starmer was using the same attack lines that we kind of thought he would. He accused Rishi Sunak of making a grubby deal with Suella Braverman and putting her back as Home Secretary. By grubby deal, he means that he's had to negotiate with the Tory right in order to get back into office. Then Keir Starmer attacked Rishi Sunak for his wife's tax status. He asked when the non-dom loop is going to get closed. He referred to a video that showed Rishi Sunak saying that rich constituencies are going to get more funding. He's really trying to show that Rishi Sunak's out of touch in a cost of living crisis. And Sunak's response was to refer to Jeremy Corbyn again, to insult Keir Starmer about living in North London again. And it's a worrying time, actually, because Rishi Sunak is polled to be, but 2/3 of people think that he is out of touch with the British people. So it's an image that he really needs to turn around. I just want to come into your debate about benefits rising in line with inflation. The appointment of Mel Stride to Work and Pension Secretary is telling, even if there's no confirmation yet that benefits are going to rise in line with inflation. Stride wanted that to happen, so perhaps that indicates that it will. And also on the Bank of England, perhaps what needs to happen, this is what former policymakers say to me, is more oversight of the financial stability measures, and perhaps that's a job for the Treasury Select Committee. And it links with the Mel Stride question because he has vacated the chairman's seat at the Treasury Select Committee, so perhaps a job for his new successor.
Lizzie, just quickly here, are you surprised that the other members of Parliament didn't come in hot on what this new plan was, on what the contours of the November 17th issue was going to be?
I have to say they're still going, so I can't tell you exactly whether any of them have gone in on that yet. But I think really the overwhelming message from the government is that it wants to consider these plans in depth. It's promising to balance the books in the medium term, and saying that they are in touch with the Bank of England and the Office for Budget Responsibility closely, and so there isn't going to be a huge surprise as there was with Truss and the mini budget. They're trying to say they've learned their lessons and the bond vigilantes don't need to come out this time. In terms of what it means for the Bank of England, it hasn't really changed the rate expectations for the November meeting. What you might see is 50 to 70, a debate between 50 and 75 basis points, and given the remarks from some of the MPC recently, maybe some words about a lower set of hikes down the line.
Hey, Lizzie.
Because they've said that market pricing is too high right now.
That was Ben Broadbent just last week. Thank you, Lizzie. Great to catch up. Lizzie Burden there over in Westminster. Futures right now down about 0.5%, recovering just a little bit. It's a new world. How many times have we said that in the last couple of years? And then the world changes again. The Prime Minister in the UK, Rishi Sunak, saying this, Lisa, inflation is the enemy. And inflation right now, if anyone in power, is the enemy.
So how do you counter it, right? And how do you...
That's the problem.
And how much can, and really, the politicians do that? How much are they willing to do that, perhaps, is the better question, because is it going to be austerity? Is it going to be some sort of investment that they can't pay for right now, based on how high rates are, without really cutting back pretty dramatically with the economic growth perspective?
Every single economic downturn for the last several decades has been met with some form of counter-cyclical circuit breaker, either from fiscal policymakers who are constrained now, or monetary policymakers who are grappling with inflation. That's a challenge for the economy, and it's a challenge for this market too. Futures lower by 0.5% from New York. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg
I've seen the Bloomberg.
They have
I've been in and seen it.
lots of Bloombergs, lots of Bloomberg, lots of Bloomberg, lots of Bloomberg, lots of Bloomberg, lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
2 hours away from the opening bell. Here's the price action. Equities down by 5 or 6/10% on the S&P 500. Much lower on the Nasdaq 100, down by 1.5%. Alphabet disappoints. I can tell you Microsoft disappoints on guidance. Bramo's going to run you through that in just a moment. In a bond market, 2s, 10s, and 30s. Think about the journey where we've been over the last week. On Friday through 460. Right now on a 2-year, back to 443. Yields lower again. The house price growth data out of the United States yesterday softer, much more negative than anticipated. Yields lower by 5 basis points today and much lower yesterday too. On a 10-year, down by another 5 to just north of 4% on a US 10-year. A ton of focus on the UK right now. I think we've also got to focus on the other side of the story, which is just a much weaker dollar through G10. Much weaker dollar, and pound sterling 115.81. I said think about the journey. Well, cable's at 115. Earlier on it was through 116. It's up about 1% on the session today. And at the end of September, it was 103.50, Lisa. So that's quite a range on a major currency pair over the last month or so.
So how many people have you talked to who say, with conviction, they're all in? They're buying the pound here. They think it's a great bargain.
You think I speak to anyone with conviction about anything?
Well, sure. I mean, how many people do you come on and talk about that?
Isn't that the problem right now? I speak to so many people and they don't have conviction about a thing.
Okay, well, this is one area that's trading like an emerging market, so how do you deal with that, right?
Tremendously difficult. And for the governor of the Bank of England as well, even more so. Now they've changed the sequencing over when we get the fiscal plan out of the UK.
And when you talk about conviction, that really comes to the stock market, too. It's unclear what the narrative is, how much has been baked in, and this really was highlighted by some of the big tech earnings. We already see a decline of 28% in the NASDAQ year to date, and yet some of these disappointments were met with pretty severe downturns in some of the shares. You're looking at Alphabet or Google shares down nearly 6%, Microsoft shares down 6.5%. Alphabet came out, Google came out. They did disappoint. They talked about shrinking some of their workforce, possibly trying to crimp some of the costs that they're really seeing with the margin compression. That's not as surprising as Microsoft, and a negative outlook, a downgrade to what they expect for the Azure, for their cloud computing unit. How much does this speak, as we were talking about earlier, John, how much does this really speak to the slowdown more broadly within tech, and Texas Instruments really speaking to that too? Those shares down 5.4%.
We'll leave those three names up and look at them. It's the breadth of the story here that's got everyone's attention. It's the ad spend at Alphabet, the disappointment there. It's the guide when it comes to corporate IT budgets for cloud, as you mentioned, over at Microsoft. And then Texas Instruments. We've talked a lot about chips. We've talked more so about iPhones, smartphones, computers, all of that. Now we're talking about something much broader than that, and that's what Texas Instruments speaks to. It's about industrial machinery. It's the breadth of the story overnight that I think is of some concern to a lot of people.
And it's the reason why Meta or Facebook is going to be so closely watched after the bell today, and Amazon and Apple tomorrow. If you take a look, you are seeing the declines in sympathy there, perhaps not as severe, but 3.9% decline over at Facebook. Amazon's going to be really interesting because that's even broader, right? You see the declines there as well. But Apple, those shares actually outperforming. They're down just 0.4%. But how much are they coming under fire from their peers, saying you guys are not acting fairly? And how much does this really unite some of the big tech names against them because of their app store policies that have gotten really controversial?
If there is a name that can define an earnings season, it's Apple.
Yeah.
And we've been steadily lowering the bar over the last couple of weeks, and some great reporting here at Bloomberg talking about how disappointing some of the iPhone sales might have been, that the demand might be faltering somewhere at some point. We'll find out. I've just find myself talking about that so many different times. I feel like I've been part of this movie before, and it ends the same way. They knock it out of the park. So if they don't this time, I think it still will have that element of surprise, even though we have lowered the bar, because people are used to lowering the bar and then knocking it out of the park every single quarter.
How much is that the reason why the shares of Apple have outperformed? They're down only 14% year to date.
People don't believe it.
People don't believe that they could be a victim of the slowdown. So what happens when they aren't? I think that's really well said.
Is your iPhone slowed down? Has it?
A little bit.
Does it stop charging?
I don't really want to talk about it.
Always do this, don't
I know. I don't want to be a conspiracy theorist.
I say they, not part of the conspiracy. Just saying it always seems to happen.
They target you?
I've got no idea. Maybe they target Ashok Bhattacharya, joins us now, Deputy CIO of Fixed Income at Neuberger Berman. Ashok, I won't ask you about whether your iPhone's slowing down or not. Let's talk about fixed income. We've had some bad news, sir. We saw it in house price growth data yesterday, and Treasuries rallied. I have to say that's new, because typically Treasuries are part of the bad news and they don't rally at all. Can you take any signal from now, or is it still too early?
I think we're getting into the zone where, like, our biggest view is the thing that's coming for the bond market is a period of devolatilization, if that's a word, but less volatility. And the reason for that is we're going to be reaching, like, the bond market's priced for 4.75 to a 5% terminal funds rate. Fed, last Friday seems to be signaling they want to start thinking about that pause that has been anticipated all year. But once that happens, you're going to pin the front end of these bond markets of 2-year yields. And then the 10-year yield is going to start moving a little bit more on expectations of growth and whether or not the Fed will ease in 2023 or 2024. And when that starts to happen, the 10-year yield starts to get bounded by just how quickly the Fed could ease, as well as, how strong the remaining inflation data can be. But what that really, I think, is transitioning the bond market from is a market where we've been driven exclusively by inflation and the central bank reaction function to an environment where we're going to be driven more by growth and the amount of slowdown and how that ultimately impacts inflation. So we don't expect, like, 10-year yields, maybe we can near term, we'll get back down to 3.75 or something like that. But as long as that's generally correct, that we're going to get a bit more of a growth-centric bond market and a period of less volatility, it should open up for, a lot of capital to come back into fixed income, and that's the core thesis we have.
How concerned are you, Ashok? We've been talking a lot about political risk and pushback against some of the central banks for moving too quickly and crimping growth at a time of great political risk for the people in charge of the fiscal budget. How concerned are you that the pressure will push the central bankers away from being as aggressive as they might have to be to crimp inflation, leading to a sort of stagflationary or sort of higher inflation environment for longer that really pressures yields for longer?
That risk is definitely rising, and I think it's something that's going to play out for the next couple of years. But it will be a couple of dimensions, because the big thing for this UK news and then the retracement was this has generally been an environment this year where fiscal policy and the stimulus was naturally declining, and central banks were hiking, and both authorities were going in the same direction. And then the UK comes around and we suddenly have, expansive fiscal policy with tightening monetary policy, and it's just sort of inconsistent. So I think the two things that are coming in the coming periods are exactly what you said, whether, there's pushback on the central banks. I think we're at a point where central banks are not going to be very responsive to that. They're going to stick with tightening, at least for the Fed. But the other issue that's coming is whether or not, just as the UK is course correcting to tighter fiscal policy, that becomes more of a broad theme, and balanced budgets and tighter fiscal policy happens over the coming 12, 18 months in other areas and could accelerate any growth slowdown. So I think both of those risks they're developing.
Either side, what does that mean for a credit cycle that a lot of people still think is pretty resilient, at least as far as what's being priced in? And then you have the likes of some people, Nouriel Roubini among them, saying people are missing the forest for the trees here. There's going to be something more significant going on.
Well, I think we're in the camp that at least, the next 12 to 18 months will be a pretty benign fundamental environment for credit. And, I do think the market is generally recognizing that, or shares that view. Even when equities were making, new lows for the year, high yield spreads, 50 to 100 basis points off of the widest spreads we saw. So credit has generally been holding in better. But I think the main thing that we're thinking about for credit investing is the whole world is going to have to adjust to this higher rate structure. But issuers that have a lot of floating rate debt in their capital structure, they're going to be adjusting first. They're going to see the higher interest expense, the declining leverage, declining EBITDA coverage. Our sense is generally that's not a default event. It's more of a risk of downgrade is how we see credit markets. But fixed rate capital structures, they have a little bit more of optionality to see how the rates picture develops. So I would characterize us as a bit more concerned about what the interest rate environment means for leverage statistics rather than expecting, a significant default wave over the coming 12 to 18 months.
Ashok, just quickly on the index, on the high yield index specifically, can you speak to how much the quality of that index has improved over the last 5 years or so? And perhaps give us a decent idea of how much signal or lack thereof we can expect from that index when it comes to telling us how weak this economy is getting and how quickly?
It's a great point, and I think it's something that the market will be, the appreciation of what you said, Jonathan, is rising. So the high yield market has gone from roughly sort of a third double B to over 50% double B issuance. It's increasingly more of a permanent capital structure for companies than a speculative type of capital structure. Now, there's certainly single B, triple C issuers, but the overall composition of the index is the highest in terms of rating, is the highest it's ever been. I think the other element of it is it's a shrinking market. Net supply in the capital markets or in the more speculative capital is increasingly going into the loan market and into the private debt markets. And it's leaving the high yield market in a position that is not the high yield market of 10 or 20 years ago. So I think, as you said, reading too much of a macro view into high yield spreads it's getting, I think, a little harder to draw that conclusion.
Really important stuff, Ashok. Always appreciate your time, sir. Ashok Bhatia there of Neuberger Berman. Lisa, that final point there, I think it's tremendously important. To his point, people are slowly starting to appreciate it, but how many people come on the program still and say, well, look at spreads, they tell you this and things are okay. You need to be looking elsewhere.
Well, and especially because people use this, or they did traditionally use this, as kind of the sort of red flag.
The
as
leading
far
indicator.
As what happen, and it's not anymore. Although, what does this mean about private credit?
Exactly.
And that's, I think, the bigger question.
And how much insight do we get into what's happening there?
And how soon before the problems already emerge?
Hey, it's super tough. Neil Dutt is going to catch up with us from Renaissance Macro at about 8:30 Eastern. You two are friends again, aren't you? Best friends, I saw.
He believes in human progress, and I do too.
You two
I
are
think
both on the same page.
We are on the same page right now, and it's a beautiful thing.
That's remarkable. Neil's coming up a little bit later. Looking forward to that. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New British Prime Minister Rishi Sunak has delayed an economic strategy announcement that was due to be delivered on Monday. It will now be released on November 17th. Sunak's seeking more time to make what his office calls the right decisions on managing the British economy. Europe is running out of time to act on natural gas before winter. The bloc still can't agree on what a price cap should mean. Policymakers have gotten a break. There's a surplus of gas in Europe thanks in part to warm weather, but that's caused the sense of urgency to fade. A new report from the United Nations paints a grim picture of global warming. It says Earth is on track to warm by more than 2 degrees Celsius by the end of the century, despite plans to cut greenhouse emissions. The UN says the good news is that projections show emissions won't increase after 2030. Higher prices have pushed consumers to tap the brakes on how much they charge up. Visa saw spending growth slow the most in about a year. Volume rose 10.5% to $2.9 trillion in the fiscal fourth quarter, a decrease from the 12% growth reported in the previous 3 months. Profit still exceeded analysts' expectations. And New York is still the most expensive rental market in the U.S., but Boston has now passed San Francisco for second place on the list. According to rental listing company Zumper, the median one-bedroom rent in New York now $3,860. Boston rose almost 6% this month to $3,060, while San Francisco is $40 less. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The kind of crack in the inflation landscape is going to take a while to get into the index. I can make a compelling case that we are moving in the right direction, that the opposition wants to take us in the wrong direction, but yes, it's going to take some time before it works its way into the index and people feel it, I think, more noticeably.
That was Jared Bernstein of the White House Council of Economic Advisors, a few weeks out from the midterms from New York City this morning. Good morning. Here's the price action. Negative on the S&P 500, down about 0.7% off the back of disappointing ad revenue numbers out of Google, disappointing guidance for software, cloud spend down at Microsoft, and disappointing numbers as well from Texas Instruments. A broad sweep of negative news after the close yesterday. A little bit later after the close, we get Meta, Facebook numbers coming up shortly. Rally in the bond market, that continues this week. This morning, we're down by about 4 or 5 basis points, just north of 4% on a 10-year. Talked a lot about this rally in the bond market and the weakness you're seeing off the back of it in foreign exchange. A weaker dollar, euro dollar, positive 0.6%. 10023. We have a 1 in front of euro dollar again going into the ECB tomorrow and looking potentially for a 75 basis point interest rate hike. We had some news out of Russia in the last 60 minutes. Vladimir Putin, a Russian leader, has been speaking. Wanted to get Maria Tadeo to jump on the phone and get us up to speed on all of that. Maria, can you walk us through what we heard from Vladimir Putin in the last 40 minutes or so?
Jonathan, and the key here is that you have to pay attention to what Vladimir Putin says and what Russia is doing, whether you believe what they say, whether they mean what they say. That's a separate story. It's very clear by now that we are in a propaganda war too, but what we have today are pictures on Russian TV. Vladimir Putin is overseeing nuclear drills, and the Russians say they have completed this training. Everything was on target, and the training has gone as they expected. Otherwise, it has been successful. Now, there's a number of things you have to keep in mind. There has been a flurry of calls now from the Russians about this dirty bomb. This is an explosive that's wrapped up in radioactive material. They say Ukraine is planning to do this. Ukrainians deny this. They say take the nuclear atomic agency, agency to come to Ukraine and check it. This is not the case. But nonetheless, the Russians say this. Today there's a drill. The way that some interpret this is that either Russia is trying to reach out to the West to get diplomatic channels going on, or actually this is a false flag for what could be a serious escalation in the war. And also, Jonathan, put this in context. This is now a very sticky war. We're now entering the winter. This is very complicated to move people, to move men, troops, army, weapons in the winter. And Russia's in a position when they're not advancing. They're having to stay in position, defending targets. And Ukraine says their counter operation continues. So the pressure for Vladimir Putin increasing domestically. This is the Russian army, the pride of the nation. Technically, on the ground, it's a different story. So you have to read the signals here. I'm being told it's two scenarios. Either this is a false flag that's in the making, or Russia, given the desperate situation on the ground, is trying to make, communications channel now back on with the Ukrainians. That's dead. That's why they're reaching out to the West under the pretext of the dirty bomb.
It's a concerning time, Maria. Thank you for jumping on the phone and running us through all of that. We heard from the President of the United States, Joe Biden, in the last 24 hours on this topic. He said, quote, Russia would be making an incredibly serious mistake were it to use a tactical nuclear weapon. I have to say, Anne-Marie, AMH, you were in the room with the President yesterday when he got his booster shot. Can you walk me through what's going on with this administration? Because we had this bizarre chain of events happening yesterday where 30 Democratic progressives wrote a letter about pushing the administration to go towards some kind of diplomatic solution and then retracting it and walking it back. What on earth is going on?
Well, let's just say clearly the White House is saying that nothing has changed in their approach with dealing with Ukraine and that they are not in a moment to negotiate with Russia at this time. And then you have, though, Jonathan, what's happening, as you say, it's quite confusing. A lot of people are shaking their heads and unsure of where this is coming from. These 30 progressives released this letter that said maybe now is the time as we pair some of these economic assistance alongside diplomacy, even including potentially sitting down and talking with Russia. There was a ton of blowback on this letter from the progressive wing of the Democratic Party. So then they retracted the letter, and you had the caucus chair, Pramila Jayapal, come out and say it was a staffing issue. They didn't vet it because this letter was circulating in the summer, but then at the same time said, as the chair, I take control and I take the responsibility for this getting out. The issue of course, is you have to think, and I'm hearing from representatives saying, well, I signed it in June and it was a different scenario. Was it really a different scenario? Yes, there wasn't a talk of a dirty bomb every day making headlines, but what you did have in June was President Putin installing authorities in occupied territory. And of course, that led to the annexation, illegal annexation of these territories in October. And then they were still fighting on the ground.
But Anne-Marie, that's a political back and forth, and we can get into that. We will get into that. Everybody is talking about that. There's a broader issue, which is that both parties, but the Democrats in particular, because they're in charge, are grappling with the economic blowback of this conflict and some of the sanctions. Is there a cohesive message that we're getting, especially after we heard from Sherrod Brown yesterday, talking about the concern about the Federal Reserve's actions with inflations in terms of what they would like to see put into place that could crimp inflation more significantly?
Well, what's interesting about this letter from the progressives, Lisa, is that it was 15 days before a midterm election where what is the #1 issue, poll after poll? It's the economy, and then right behind it is inflation. So you have this pressure on lawmakers across the board about to deal with rising consumer prices. And this is what the struggle is and why people may go out and vote, why many are saying the polls are closing and there potentially could be this red wave. At the same time, you asked about a cohesive message. I don't think it's cohesive in terms of how the Democrats are approaching the economy ahead of the midterm elections. You had the likes of Sherrod Brown. Of course, he's the chair of the Senate Financing Committee, so he's the one that has to overlook what the Fed is doing, writing this letter to the Fed on the heels as well of Senator Bernie Sanders, Senator Warren over the past couple of months talking about the Fed. Are they going too fast? They have to keep in mind the unemployment. But is by and large the Democrats using the Fed as a scapegoat? Not yet.
AMH, down in Washington. Anne-Marie, thank you. Got to talk about two things with regards to this letter from the Senate Banking Committee Chair, Sherrod Brown. The optics and the content. On the content, there will be many people that believe he has a point including the Wall Street economists that come on this program, and have flagged exactly what he's saying, which is the Fed's actions do not address some of the main drivers of inflation. Then you've got the optics. For all the complaints about the former administration, about the way they dealt with this Federal Reserve, if this pushback grows from the other party down in Washington, D.C., then they're both playing the same game. And this Federal Reserve, I think, is finding itself in a very, very sticky spot. When I saw these comments yesterday, the first thing I thought of, and I mentioned this earlier this morning, were the comments from Chairman Powell in Jackson Hole at the end of August. When the chairman comes out and effectively tells everyone, doesn't even whisper it, that what we're going to do is cause some pain. But if we don't, there's greater pain for not dealing with it. So ultimately, what they're telling you, and it's in their projections, is that the objective is to get unemployment up. That's part of the goal, to get unemployment up, to get inflation down. And we've said repeatedly on this show, it's going to be very, very difficult to convince people in Washington and across this country that higher unemployment is a price worth paying to get inflation down.
And this is going to be a very difficult thing, because how does Fed Chair Jay Powell continue to reinforce that message when the political blowback starts to get that much more intense?
If it does get more intense, particularly ahead of next week when this Fed is set to go again, potentially by 75 basis points. Coming up in the next hour, do not miss this. It's Mike Wilson at Morgan Stanley next.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. Multi-trillion-dollar industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Right now, all central banks are playing tough and talking tough and acting tough.
I think that the Fed is highly aware of what they've done to financial markets.
This is a world where we're going to see a very significant slowdown of activity.
In this economy, the recession risks that we're seeing are by no means uniform.
Everyone's waiting for this Fed meeting next week, but I think the message will be, no, we're going ahead, we're still staying hawkish, and the dollar will rally into Christmas.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
No Fed speak all week. It's been wonderful, blissful, I have to say. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. TK back with us tomorrow. Futures right now down 0.75% on the S&P. We've had a nice run. 3 big days of gains, Bramo. And then the earnings hit us around the head yesterday evening.
Do you really think it's been blissful for the past couple of
wonderful.
days?
Without
Really?
the
You
Fed
think so?
Oh, for sure.
This has been sheer bliss. Other
I
than
love the
down
quiet
market.
period now.
It
I
is,
love the quiet period.
It definitely creates more focus on the actual data. And the data has been softening on the macro level, which
Sure.
was bad news was good news. And then you got the earnings, which perhaps changed the scenario and really raises the specter of how much has actually been priced in, given that any misses were heavily punished in the aftermarket hours.
We've talked about this a million times. Can you make the argument we've priced in a bulk of the rate hiking cycle? If you're pricing a 5% terminal rate, I think you could probably make that argument better now than you could 3-4 months ago. Fine. Have we priced in the consequences of that rate hiking cycle? Most people on this program say no, we haven't. So we started to see some weakness of the earnings, and it was a broad sweep of earnings too. It was ad spend at Google. It was IT budgets, corporate IT budgets in the Microsoft projections that got people's attention. Bit of concern there. Texas Instruments as well.
Yeah.
Just speaking to the story that this is not just about smartphones and computers, that this slowdown might go beyond that.
And you talk about how we haven't necessarily priced in the ramifications of higher rates for longer. We don't even understand what the ramifications of inflation themselves are on some of the consumers, right? So how much is this just because inflation is high, consumers are pulling back? We don't know where the economy is going to be, just in a broader sense. The issue is, if you get an economic slowdown sufficient for a step down or some sort of slowdown in the pace of rate hikes, is that good news or bad news? You've been asking that all year. And right now, at least treated by the earnings and the way that they've been treated in aftermarket hours, it has been bad news. Bad news is bad news. And how much can that continue?
It depends why they're doing it. Now, if you're going from 75 to 50 to 25 because the economy is slowing down, that's not great news. If you're going down from 75 to 50 to 25 because you get this positive supply side response, that's good news. That's bullish. That's great. They've got to back away of rate hikes because you've got the supply side solution to the inflation problem. But if they've got to destroy demand, problems. If it's because of financial stability, big issues. And that's what Mohamed El-Erian had to say on Bloomberg yesterday.
Here's my issue, and this was really highlighted by Google earnings yesterday. You heard the CFO come out and say that it takes time to move this ship, right? That they're trying to pare back some of the headcount. They're trying to pare back some of the expenses in order to have bigger margins, but it takes time. So they have to get those plans in place. If the Fed turns around and stops raising rates as much, how much of an actual effect does it have on the economy that's already turning around, that already will lead to higher unemployment?
It was pretty bearish stuff there, bro.
Look, we listened to, Nouriel Roubini, and he made some good points.
I said to Mohamed, I caught up with Mohamed after we caught up with Nouriel.
Depressing.
I said to Mohamed, it's good that Nouriel came before you because he set the bar so low that even Mohamed was sounding constructive.
I was about to say.
Relative to Nouriel.
He sounded downright optimistic. It's not a done deal that we're going to get recession. That was basically bull.
Since when was this optimistic to say it's not 100% a done deal that we get a recession? That's constructive these days?
Especially from Mohamed El-Erian.
Okay, that tells you a lot about sentiment.
And it tells you something about also following Nouriel Roubini.
Sure. Futures down 0.75%. I have to say, I started the book last night.
It's a good book.
If I come in day after day, increasingly bearish, you know why.
You're not going to shave. You'll come in looking haggard.
I messaged Nouriel last night, said I've started the book, and let's see how You can follow me and say what I sound like in the next few weeks.
Life
all right?
with Nora Urbini.
Futures down 0.75% on the S&P. There's a rally in the bond market. Yields are lower by 4 basis points. We're just above 4% on a 10-year. That rally in the bond market continues. Interesting to see some dollar weakness out there as well. Euro dollar back above parity, back with a one handle on euro dollar. There you go. Euro dollar positive about 0.5%. But Lisa, I think that rally in the bond market is curious off the back of bad news. We're finally starting to see the risk mitigation characteristics return to the bond market in response to negative data, specifically off the back of that house price growth data in the United States.
And will it all be killed with the CPI report, right? I mean, at what point does the proof really come in inflation that isn't coming down in certain areas? People think that, yes, housing prices are increasing at a slower pace. You're seeing retailers discount certain items. You're seeing car prices, used car prices, not new car prices, come down. How much will that really bleed into broader, lower inflation versus simply kicking the ball over to employment costs and other issues?
I keep saying there's a man on Wall Street with a crystal ball, and the fortune teller joins us right now. Mike Wilson, the CIO and Chief U.S. Equity Strategist at Morgan Stanley. Mike, wonderful to catch up with you, sir. I say this because you come out last week and talk about this short-term tactical call of a market that's going to mount up a little bit, maybe through 4K again on the S&P 500. And here we are, massive week of gains last week, first couple of days this week, pretty tidy as well. What is it about the short term, Mike? And we can talk about the longer term, but what is it about the short term between now and maybe the start of next year where you become a little bit more constructive?
Yeah, it's a tough gig, right? Making predictions is a tough job, especially about the future. But that's the life we've chosen. And look, we have to try and make these tactical calls when we feel like they're actually tradable. And we do feel like we got to a point a couple weeks ago, mainly for technical reasons. But there are some fundamental things that are changing too. Now, this summer we didn't actually try and pivot into that tactical move because we didn't have all the elements. Let's talk about them one at a time. The first one is, sentiment and positioning is extremely bearish, probably as bearish as we saw back in June at the last time we had a tactical rally. Secondly, though, we got to the 200-week moving average. That's something that we did not achieve in June. And that's a very important technical level that a lot of people don't talk about. We look at it very closely. It is your long-term support level. And to break that level, you typically need a recession. Okay, now the odds of recession are very high, as you were just speaking, but we haven't seen the whites of the eyes of that recession yet. And until you get that, you can usually hold that 200-week moving average. That was a big factor. And then probably the most other important factor is we think rates are topping. Rates are looking very toppy. Our rate strategists have done a great job here. They've gotten more neutral. They're now calling for no longer bear flatteners, but actually steepeners. And that's going to be mostly at the front end. But nonetheless, the back end's going to come down too as the market starts to think about the Fed pivoting. And then the last thing is the earnings story. As you guys know, I mean, that's where we've been focused. We're probably more bearish than most on the outlook for next year. But, we got earnings this quarter. And what we just don't think we're going to get, John, is we're not going to get the full capitulation from companies on 2023. We think it's just going to take longer. We've written about that quite a bit. You read our research. So how we're thinking. We're still bearish in the intermediate term. We don't think the bear market's over, but we do think this tactical rally is going to be big enough to try and pivot and trade it. For those clients who can do that.
How far along, Mike, are we in this tactical rally?
All rallies and all downturns are about time and price. Lisa, as you know, I would say in terms of price, we talked about 200-day moving average now is an achievable level. That's sort of 41.50, but it's coming down. So depending on when you get there, that'll determine the level. I think in terms of time, it's probably into the holiday period, maybe Thanksgiving. Then we'll get the sort of the Black Monday results, from the holiday shopping season, and we'll see if it is going to be a Black Monday or a Red Monday. Do we get the sell through? We're pretty discouraged, in terms of what we think we're going to get through on holiday sell through. Mainly because what you just mentioned, there's going to be a lot of discounting to move some of that extra inventory, something we've been highlighting for a while. And so that's when we'll get the next chance to perhaps see, the fundamentals overtake the technicals on the downside. And then we think ultimately the bear market will be over probably sometime in the first quarter. Now, all of this is, subject to revision, right? So I want to make it perfectly clear, if the market starts to trade off again and the S&P breaks down and blows through 3650 on the downside, we'll be bearish again, okay? But, this is our job. We think, and we like the price action the last couple of weeks, notwithstanding, some negative earnings reports last night. We think maybe the market will hold up, and that'll be another positive catalyst, because if stocks don't go down on bad news and the market isn't going on bad news on fundamentals, then what do you have?
And Mike, you talked about this difference between technical factors and fundamental factors. In the near term, what's the optimal way of paying that tactical rally in the equity market? How do you want to do that? Through the index of the S&P or somewhere beneath it, somewhere else?
Yeah, good question. I mean, first of all, the call is really, to help our clients who, can short stocks, right? So the main call was just get out of the way. And because when you get these kinds of rallies, the shorts usually go up the most. And that's what's happened so far. So it's a low quality rally so far. The shorts have rallied the most. So some of the expensive, kind of growth stocks, some of the low quality cyclical stocks, the small caps have had a little run here. That will probably persist. And then I think ultimately it'll morph into probably NASDAQ leading because rates are going to come down, right? Part of our call is that rates have to come down. If rates don't come down, John, and we don't go below 4%, like in a meaningful way, the rally will peter out probably around these levels. But if that happens, as we suspect, and rates do come in, then you'll see these growth stocks have probably a pretty meaningful move, despite the fact that maybe we're getting some bad earnings reports.
We're going to talk a little bit more about the fundamental stuff in just a moment, but just a little tease, Mike, if you can. 2023, early 23, it's earnings season for Q4 and maybe some guidance for the rest of the year. You said we haven't had it yet. We haven't had that overwhelming negative guide from corporate, C-suite management, all the rest of it in America. Mike, how do you know what that looks like? What does that look like? What do you think that looks like? How will you know when you see it?
Well, those are trade secrets. I can't share that. No. I mean, look, we'll know it when we see the forward estimates really come down, okay? In other words, so far, let's just talk about some numbers. It makes it easier for people to kind of follow what we're looking at, which is, so we think markets trade on next 12-month EPS, okay? And in the S&P 500 case, that got to 240. That was the peak in June. We're down to about 233, 234, which is only about 2 or 3% off the highs. We think that ultimately is going to go to about 195. So when we see that forward estimate get down about 30, 40, 50% in its way to the ultimate destination, then we'll feel like, okay, it's there. We're not going to wait for 195. By then, the market would have definitely discounted it. But at 233, 234, that's not anywhere near where we think we need to be to say, okay, the market gets the joke. And that's something like 220, 225, John. That's kind of what we're looking for in NTM EPS for those people who follow it.
Mike, they're playing the music. They want us to go. So we're going to continue this conversation in just a moment. Mike, stay right there. Mike Wilson there of Morgan Stanley. Equity futures down 0.7 on the S&P from New York. This is Bloomberg.
Gotta love that music. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New British Prime Minister Rishi Sunak has delayed an economic strategy announcement that was due to be delivered on Monday. It will now be released on November 17th. Sunak seeking more time to make what his office calls the right decisions on managing the British economy. The government is seeking to plug a fiscal hole of more than $40 billion. Former Treasury Secretary Steve Mnuchin indicates the Federal Reserve's fight against inflation will show results soon. Mnuchin spoke at Saudi Arabia's Future Investment Initiative.
You are going to see inflation in the U.S. begin to come under control. Now, it will probably be a 2-year period, but you're going to begin to see that, I think, relatively quickly. And I think people are overestimating the Federal Reserve's actions, just as they underestimated it.
Mnuchin also said that China faces a significant slowdown that will have an impact on the world economy. Bloomberg's learned that Elon Musk is promising to close the acquisition of Twitter by Friday. Musk made the pledge in a video conference call with bankers helping fund the deal. They're providing $13 billion in debt financing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
No one covers the world like Bloomberg.
Because Trussonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Season is here.
The earnings are starting to pour in.
The numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going across the wire.
A big beat. Stock is up more than 8%.
Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Right now, all central banks are playing tough and talking tough and acting tough. If they try to get to 2% inflation, they cause a recession. And this recession is not going to be short and shallow. It's not going to be garden variety. It's not going to be plain vanilla. It's not going to be 2 quarters of negative growth, then inflation collapses and they can ease again.
Nouriel Roubini, the CEO of Roubini Macro Associates, out with a new book in the last week or so as well. Pretty depressing stuff. But on the short and shallow stuff, I have to say, think about how the consensus has shifted through the year. Do you remember we were never going to see a 50 basis point hike? Then we were never going to see 75. Then we'd never see 2 75 basis point hikes. And surely rates wouldn't go through 4. A 5 handle? Absolutely no chance. Here we are. And now it's all recession, short and shallow. The overwhelming consensus.
Right, and as you've said, is this the new transitory? The interesting thing is, Nouriel Roubini, I asked him, you know, do you get a lot of pushback? You're always bearish, so why should anyone listen? And he said, from people who actually are in the know, when they read this, you're laughing at me.
You
and
know,
he
I'm
said,
laughing.
no, because
he
said,
I feel like you're asking a friend. Do they ever push back against you? Because they push back against me all the time. Were you asking for yourself?
Don't we have a guest?
Were
We
you
have a
asking
guest.
for
Can we
yourself?
move on?
We got
Well, I'm
Mike
just
Wilson.
saying it. He said, like, people agree with him, which I think is interesting. He has some good points.
Okay, cool. I'm going to get to Mike right now.
Thanks, good. Hi,
Mike. You just won, and I'm happy to say you were just ranked the best portfolio strategist in the latest institutional investor survey. Mike, I know you well. You'd share that prize with the whole of your team. Mike, can we start there? Can you walk me through What has really given you and the team the edge this year as you've worked through a really fast-moving economy and a tremendously difficult market?
Well, thanks, John. I appreciate that. And you're right, it's a team effort. I mean, a lot of effort goes into this ranking. A lot of it has to do with just client service, if anything else. Our calls have been right. But, what clients pay us for and what clients really want from us is critical thinking and, holding their feet to the fire on, kind of what's happening. And I think what's allowed us to maybe get ahead of the curve a little bit is I'll go back to 3 years ago, and our research well. We first started talking about the recession itself. It was going to be really nasty, but then the V-shaped recovery, and we said the next cycle will be hotter but shorter. And so having that framework, right? We're cycle analysts, a little different than psychoanalysts, but we're cycle analysts, and we look at history. Yeah, well, it's similar, but it helps us understand kind of, okay, well, what does this period look like? They're never the same exactly, but having that context, that historical context, we spend an enormous amount of time on that. Plus, I'm a little bit older, so some of it I lived through. And we understand when we see something, okay, it's different this time, and that helps us sort of stay ahead of the pack. Not always, but I think in this year in particular, right, we saw early on that this was going to be a shorter cycle. The Fed was going to have to move faster than people expected. That was going to, curtail expectations on profits. Ultimately, as the fire and ice narrative has played out, and that, so just being willing to kind of get in front of the pack, I think has really helped us, not just this year, but in years past as well. And of course, when you do that, you run the risk of being wrong. Okay, and we're wrong occasionally, and it's not always right. But you have to be willing to go there. You have to be willing to take a shot and get away from the consensus.
Mike, given the historical perspective that you do bring to this, where are we in terms of the ice and short and shallow, and this question of, okay, if it is deeper, how long will it last, and how long can inflation remain prolonged? When you take a look at when you start to find optimism in the equity markets, perhaps early next year, is that predicated on this idea that we are not going to be in some sort of high inflation environment for a very long time?
Yeah, I mean, here's a great example where, we have a view that is not consensus, and we have more conviction in it. We've been actually thinking about this for 4 or 5 years. If you go back and look at our research, we didn't just pull it out of left field. We think we're entering, the end of financial repression, the end of secular stagnation, and actually the pandemic was the catalyst to kind of break us out. Now, of course, we're experiencing this first wave of inflation, which was spectacular, and, more than people expected. But we think we're into what we think is a boom-bust environment. It's very similar to the post-World War II period of 40s and 50s, where we had more frequent recessions and inflation was volatile. Okay, so it wasn't higher and then stayed there. It was high, low, and the trend is up. Okay, so we have no sort of naive belief that we're going back to the way the world was, lower for longer, and the Fed can continue to keep rates at 0 or lower. We're never going back to that. It's going to be something different. But we also don't think it's the 70s where we're going to have this cost push inflation. We've always said that we think it's a demand pull inflation, and that demand is waning now as supply picks up. And so that will create the ebbs and flows. And what we really think we're in is a volatile economic outcome, which includes inflation and includes nominal GDP, includes all the factors, and it's just going to be a lot more volatile, and that's just a different environment. And if you understand that, it can be quite profitable if you understand how to trade it on both sides.
Mike, just a final question from me then. Does it tell you anything at this point, and how does it influence your thinking about future leadership in this market after a decade of growth dominance on the S&P?
Yeah, we're not in the camp that it's just going to be one or the other. We think it's going to be a broader kind of market where you get broader participation, kind of like 2020, and it was broader. It was small caps led, right? We had growth and value working together. I can tell you this: the days of ridiculously priced growth stocks, that's over. Okay, and that, by the way, that was dumb to begin with. So that's good. You take that stuff out, and then, but that doesn't mean all growth stocks are doomed. It just means you can't overpay for it the way that you could when rates were negative. Okay. So we're not going back to that environment, which means you have to focus on companies that can actually operate efficiently in this more volatile economic environment, deliver the goods on earnings, and then pay a reasonable multiple. It's kind of back to basics. It's kind of the way it was when I first started in the business. Get the training wheels off the bike and learn how to ride again.
Hey, Mike, just wonderful to catch up, and send our best to the team, won't you? Congratulations, Mike Wilson of Morgan Stanley there. Lisa, the best portfolio strategist in the latest institutional investor survey, and some tremendous calls over the last 12 months and beyond.
He didn't show us his crystal ball, but
He didn't.
we did get the sense.
He did imply he might have one.
The gold, the
What did he say?
glow
The
right
trade
next
secrets.
to him. Yeah, exactly. Please don't. It's really fun. No, look, he's gotten it right, and I think that the really interesting thing is he's not afraid to talk about a tactical rally, to embrace something that is going to happen even if it doesn't cohere with a neat narrative. And I think that right now, that is one of the most difficult things, is it's easy to get caught up in a narrative, but sometimes the positioning can rip against people. And I think that right now, we're in a period where there's been a lot that's been baked in, and the short positions, as he said, are what potentially could hurt people, right? So he wanted to basically say, get out of the way.
Sure.
I thought that was really interesting.
I think we've said it a few times. I've said it a million times in the past. It's not about being right or wrong. It's just about working through the process sometimes and understanding the framework of the individuals that do have the success. We can all get lucky and say we're going to be here, going to be there. The source of their success is the framework, and the framework they've had is just a deep understanding of how this cycle would materialize through the pandemic and out the other side.
Yeah, and there's also an era of self-questioning and sort of ongoing, really, I don't know.
You saying that's absent elsewhere?
Well, I'm just suggesting that that's a successful
I just
trait.
wondering if you're
even
speaking
if
about
you want
another bank.
to have,
Okay, all right.
need a lot of therapy.
Your friend's coming up. Neil Dutta, Renaissance Macro is next. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. Power. Policy. Politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
telling you, over the next 12 months, we'll spend a lot more time looking at housing data, and we're going to do that in about 10 seconds' time. Good morning to you. Your equity market looks like this going into that economic data in America. On the S&P 500, we are negative. We are down 0.8% after some disappointing earnings after the closing bell just yesterday. Meta, Facebook coming up after the close a little bit later. Bond market rallying, yields lower by 4 basis points. Mike McKee around the table with that data. Morning, Mike.
Good morning, John. Well, we've got some interesting news for the markets and for economists to try to figure out how this fits into third quarter growth, because we got the September advanced good trade balance. It's a lot worse than anticipated, $92.2 billion, and that is down, well, I guess you'd call it down. It's wider than the 87.3 in the month of August. Retail inventories come in up 0.4, wholesale inventories up 0.8. Both of those are much lower than they were the prior month, but there's still a gain. And when you look at retail and wholesale inventories, you see they're running way, way, way ahead of where they had been in pre-pandemic years. And that does suggest that we're going to have some more growth added to the third quarter numbers, but it also takes away from the future. And it may give us some break on inflation if we see retailers cutting prices as they have been to try to get rid of their stocks. And the number John was referencing in terms of housing, the Mortgage Bankers Association's mortgage application index falls 1.7% in the month in the last week. That's down from 4.5% drop the week before. And when you look at the overall index, it is now the lowest since 1997. So people are really bailing out of the housing market. It's hard to say that this is comparable to that period, because we saw rates higher in those days than they are now, and people were still buying houses. But it does look like the housing market is really kind of fallen off a cliff here when you look at sales to the mortgage rate. We will get new home sales, guys, a little bit later this morning.
Let's talk about that data in 90 minutes then, new home sales. What are you looking for? Mike, can you frame just how bad it is in U.S. housing at the moment?
Well, new home sales are going to be a little odd. The consensus is we're going to see them drop, but we have seen housing starts hold up generally well and building permits actually rise because builders have backlogs. So new home sales are based on basically when you sign contracts. Now, contracts are going to be canceled in some cases as mortgage rates go up and people decide they can't afford them. But it's the existing home sales numbers that will really give you an idea of where housing is. And existing home sales have started dropping tremendously. Those are based on closings, and that was mortgage rates a couple of months ago. So we should probably see further declines ahead.
You're going to stick around with us? You're going to run? You're going to stick around?
Well, I mean, you have a guest that I haven't seen in a long time.
Let's catch up with Neil.
Anxious to see you.
Neil Dutzer of ASOS Macro joins us around a table. I was told by Joe Weisenthal to ask you about your sterling target out of the UK, and I said to Joe straight away when he messaged me about 30 minutes ago, Joe, what are you talking about? Just FX targets now. What's Joe talking about?
I don't have a sterling target, but I can tell you that my kids have convinced me to go as the Prime Minister of the UK for Halloween.
You're going as Rishi Sunak?
Yeah, I definitely am.
Is Rishi Sunak coming with good things?
I mean, as I was joking with Joe, I mean, I told him very clearly that, you know, I have a habit of betting on Indian. And I told him, as a result, it's time to go long sterling.
He's got the credibility back in the market.
Yeah, exactly.
That's more than a joke for a lot of people. Let's talk about the credibility of this Fed chair as well, Neil. And it's wonderful to have you with us around the table. The politicians are pushing back, Neil. The usual suspects, Warren, Sanders, but also now the Senate Banking Committee chair as well, in a letter according to Punchbowl yesterday. How did you and the team respond to that?
Well, I think it's amusing. You know, look, if the prediction markets are right, they better get in their jabs right now, because the likelihood is that the Republicans will sweep both the House and the Senate if the prediction markets are right. And I can tell you right now that if the Republicans are playing this right, they will not have any political interest to tell the Fed to back off from hiking. So threats to the Fed's independence from higher interest rates, I think, will be dramatically coming down once the Republicans take over the Congress, because they want the Fed to keep hiking. to slow the economy down, to improve their own political fortunes going into the 2024 elections.
This is actually really important because it also suggests an unwillingness on the fiscal side at a time when we're heading into a downturn. Does this mean that any fiscal impulse from Washington, D.C., based on the outcome that you said is most likely, is going to be that much more reduced and going to be that much less of a counter-cyclical balance to what's upcoming?
Well, I think that's the case going forward. I mean, the next time we have an economic slump, given where interest rates are, and given the recent experience with inflation, I think it's highly likely that we'll have less counter-cyclical policy, both not only from the monetary side, because I don't think the Fed will be going as aggressively next time around, but also obviously from the fiscal side, because the fact that interest rates are higher means that the government's spending more on interest expense, which will limit their ability to backstop the economy.
Growing issue coming out of the election, if the Republicans take control, is the presumptive Speaker of the House, Kevin McCarthy, saying that they will hold the economy hostage to the debt ceiling, which would come up theoretically sometime in the first half of the year, and that they are basically willing to go up to the line and maybe fall over and see the U.S. downgraded or default. How much of a risk do you think that is?
I think it's a risk. I don't know that it's any more than previous years. I mean, remember, we've had this happen with, Democratic president. Back in 2011, Republicans just got into power. We pushed up to the limit. The debt did get downgraded, and what happened with interest rates, they actually declined at the time. So maybe this time will be different, but I have a feeling that they'll push up to the last moment, and if it wasn't for the last minute, nothing would get done, sort of.
I hope we're not doing that again anytime soon, Mike, but I share your fears that we might be pretty soon as well. Neil, the pushback that we often get on this show when we have guests come on and talk about runaway inflation is just to open your eyes and look beyond the data. Look at freight rates, look at what's happening with supply chains, look at what's happening with house price data, with rents in certain cities starting to roll over a little bit. When does that start to show up?
I mean, is there a statute of limitations on those arguments? I mean, that's my issue. We've been talking about those issues for the last 6 months, and that's not to say that those things aren't happening, but during that time, core inflation's actually accelerated, and underlying inflation's actually accelerated. So I think there's a statute of limitations on those arguments. I think ultimately what we're talking about there is just relative price shifting. If, let's say people are getting paid and they have their jobs and their wages are growing at 5%, okay? And now the rent burden is becoming too onerous, so everyone who decided to go out and live on their own decides to shack up with a roommate. What did you just do? You gave yourself a tax cut. If you don't lose your job, you're not paying as much on rent. That frees up dollars to go spend elsewhere, driving up the prices for those other goods and services upon which you are spending money. And so I don't know where the money's going to go, but I can tell you, absent a sort of spontaneous increase in the savings rate, it's highly unlikely that all they're talking about is really relative price shifting. I don't necessarily think that's the way the Fed is thinking about inflation, rightly or wrongly. For whatever reason, okay, and my job is not to tell people whether I think it's right or wrong. It's about trying to tell people what I think is going to happen. And rightly or wrongly, the Fed views the labor markets as the conduit to achieve their inflation objectives. And that means you need to see higher unemployment. And if that's the goal, they are failing miserably, okay? I mean, we just learned that, despite all the sort of chatter about tech layoffs, I mean, Google's still hiring lots of people. I mean, all these large tech companies are hiring lots of people. Consumers still feel very confident about the jobs market. Claims are still very low. Even if you look at regional manufacturing indicators that have been slowing down, the employment components within them remain relatively strong.
I wanted to ask you, though, about big tech. That's exactly where I wanted to go, because it's perhaps, we haven't seen the job cuts yet, but perhaps they're coming based on the rhetoric from Google, based on the rhetoric that we've heard from Meta or Facebook, based on the rhetoric that we've heard pretty much across the board. Today, Seagate Technology Holdings says that it's going to cut 3,000 jobs. I mean, we keep hearing anecdotally, yes, this is happening. So is it too soon to say that we're not going to see those broad-based tech cutbacks?
I mean, I think you are seeing those cutbacks, but I think what also is happening is that there are lots of job openings, and so those people are transitioning relatively quickly to new employment opportunities. And one of the things we find is that, the median spell for unemployment is like very low. I mean, maybe less than 10 weeks. So I think a lot of those people may be getting layoffs. Not to say the news is fake, but they're just, the fact that continuing claims remain low tells you that those newly laid off people are transitioning into new jobs pretty quickly.
What do you make of this step-down argument then? this story that came out of the Wall Street Journal, 75 to 50 to 25.
I think that's implicit in the Fed's dots plot. Now, the issue is for the Fed is that if every time they hint at a mini pivot, the market rips and break-even rates go up 10 basis points, that's a problem, and it makes the pivot less likely. So I do think, the risk is that they end up doing more than what they've already signaled in the dots plot. I wouldn't be surprised to see a Fed funds rate, well north of 5%. I think we're actually on a glide path to that. And the fact that, to me, the most notable thing that Chair Powell has said was at the September meeting when he had that kind of moment where he said, I don't know what the path will be. I can just tell you it'll be enough. That, to me, tells you that relative to whatever they've put into their dots plot, it's likely to be higher than that.
They want to put a lid on markets, Lisa, and on financial conditions.
Yeah, that's the problem, right? This sort of self-fulfilling prophecy.
Sure.
What Neil just said there, then they're on a glide path to well north of 5%, and they're going to have to get there because they can't signal anything close to a pivot unless things are so bad.
Well, there's room that things may even improve, in the equity markets between now and year end. I mean, I think that's the interesting thing is that, from my climate, I don't follow Europe closely, but, I was just in London not long ago, and I can tell you that people are feeling a little bit better about the European energy situation.
The weather's
warm. We talked about the Rishi Sunak rally. That's going to take pressure off the U.S. dollar exchange rate, which will breathe life into cyclical stocks like industrials, which, by the way, have been outperforming. So, you can see a potential melt up into the end of the year.
I've got the final word here. If you're going as Rishi, you need one of these.
I was about to say, skinny tie.
I've got to get
all
you
about
a slimmer
the skinny
tie.
I was thinking the same
I think
thing.
I have to buy the Prada shoes first.
And the Prada shoes.
And I've got no idea where that suit's from either, but I'm sure I can't afford it. Neil Dudzer, Renaissance Macro. Neil, just absolutely awesome. Thank you, sir. Coming up in the next hour, looking forward to bringing you the opening bell with Jim Keenan of BlackRock, Priya Misra of TD, and Troy Gajewski of FS Investment Solutions. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. For the first time in more than 2 decades, mortgage rates in the U.S. have gone over 7%. That's according to the Mortgage Bankers Association. Its survey found that the contract rate on a 30-year loan rose to almost 7.2% last week. That extends a string of steep increases that have really cooled the housing market. President Biden congratulated new British Prime Minister Rishi Sunak in a phone call. The two discussed the Russian invasion of Ukraine and challenges rising from China. They also talked about the unresolved issue of the Irish border after Brexit. A new report from the United Nations paints a grim picture of global warming. It says that the Earth is on track to warm by more than 2 degrees Celsius by the end of the century, despite plans to cut greenhouse emissions. The UN says the good news is that projections show emissions won't increase after 2030. South Africa has set more ambitious targets to stabilize public finances without having to raise taxes. It's also revealed the broad outline of a plan to tackle the state's power utilities' unsustainable debt. The utility, Eskom Holdings, has more than $22 billion in debt. Harley-Davidson posted third-quarter profit that beat estimates. The motorcycle maker saw sales rebound from a temporarily production shutdown. Harley was able to raise prices enough to offset higher inflation. That padded profit, even as sales in its core U.S. market declined. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
what are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, you know, and the ultimate output for a company is share price, you know, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
I think it's very hard to see something that's going to be smooth landing in any way. That's true for the economy, that's true for the financial market in this context. That's why, you know, we think we're on a clear path towards over-tightening of monetary policy, but it's going to be very rocky.
Jean Bovin, Investment Institute head at BlackRock, coming out with a bit of a gloomier view, although not necessarily seeing treasuries as a haven. They are perhaps a haven today. You are seeing yields lower. Kind of amazing what a round trip we've done over the past few weeks, with now 10-year yields in and around 4%, 4.075%, after having reached up to about 4.5%. A pretty market shift downward. Whether it can last and how much this can really give fuel to stocks. We saw a 3-day rally end today. You see the NASDAQ underperforming, down nearly 2% on the heels of some of those tech earnings. Microsoft shares down nearly 7% now ahead of the opening bell. Joining us is someone who's been bullish tactically, bearish long-term, kind of a Mike Wilson page. Perhaps he's got the same kind of crystal ball. Peter Scheer, macro strategy head at Academy Securities. Peter, I want to get your sense on what we've been seeing with earnings, whether they confirm your view that we can continue to see a rally into the short term, even though they have been somewhat disappointing.
Yeah, I think we have to make it through this earnings period. Obviously, overnight, we're not reacting well to yesterday's earnings. But as we get through this, I think the attentional focus to stock buybacks are still real. You get that quiet period. I think people are still too bearish. And for me, more importantly, this Treasury rally, I think, continues. I think we get to 370, maybe even 360 on the 10-year, and that could push equities higher. So it's a little bit short-term positive. There's a lot of technicals at work. I think longer term, this is my first real signs of my fear for a hard landing, is that people aren't going to fire employees. They're going to pull back on their services. and disruptive companies in particular have to pull back on the services, technologies they're buying, and that might be what we're seeing leaking into earnings.
Okay, there's a lot to parse through here, and I want to get to all of it. I want to start with your call on treasuries, because that's pretty noteworthy that we get back down to 3.6% on a 10-year treasury, given where we have been just recently, just days ago. What gets us there?
So one, on Friday, if you go back, there was so much lost in the news, but daily, basically, you kind of backed off a little bit. Nick from Wall Street Journal sent a message backing off a little bit. Markets reacted very well to that. I think you're seeing geopolitical pressure placed on us by Japan in particular, but also the UK and the ECB saying, hey, we need you to stop this currency devaluation we're going through. So I think there's a lot of reasons to expect that. And now with the quiet period, we can start looking at the data. I think we're going to see data coming in weaker. Oil's down every day. We're going to have easy comps. I think the whole inflation fear is way overdone, and it's starting to leak into the data. And with the Fed being quiet, we can respond to that.
So you think that the Fed is going to respond to what's going on with with the yen, with the yuan over in China, with what's going on in the United Kingdom, and try to address the dollar strength?
I think some of that will come from the Treasury Department, because that's really their responsibility. It's going to be subtle. It's not going to be, overt, because we just can't do that. But I think they're going to start saying, hey, we already said we were going to do a lot, and this isn't a pivot. We got to our plan. It's getting time to watch and wait. Right? We have done so much. We followed what we said we're going to do, so don't consider this a pivot. This is just part of our original program, was to stop at some point and see how it plays out. So I think that's the messaging we're going to start seeing as soon as the Fed's allowed to talk again.
So do you think that right now, going back to your other point about cutting around the edges, basically cutting ad service, cutting other issues that you don't know, that's not necessarily the core of the personnel of a company, do you think that perhaps the big tech earnings are not as well of a bellwether type of signal for the rest of the economy as some people are making out?
Yeah, I think that's probably true, right? They're adjusting to this specific shift, right? So there's other areas of the economy that are doing well. I think you can see autos, you can see places do reasonably well. So I think this is a unique factor. It's part of this pullback. If the Fed keeps pushing on companies and then they start having to lay off, I think this follows through even worse for tech, and that gets us to the hard landing. But for now, I think we can make it through this and start bouncing back up. Because again, a lot of these companies are down anywhere from 30 to 50% year to date. So even with these weaker earnings, there's still some upside.
Okay, this is a really frustrating part about this market, and I was struggling with this with Mike Wilson, and I could tell that he was too. And I'm curious, from your perspective, how do you communicate to people? Short-term, technical rally, but don't worry, I'm not actually optimistic about anything, and we're going to crash later on. How do you understand the pivot point in markets about when bad news becomes bad news? We start to understand some sort of hard landing that is divorced from the Fed's response mechanism.
That's a great question. For myself personally, I was trying to think in terms of, the next 20 bips on the 10-year treasury or the next 5% on equities. And unfortunately, now that means I'm a day trader almost, because it moves so quickly. So I'm trying to avoid that and really make sure that I'm explaining to my customers, okay, this is short-term tactical, this is medium-term markets, and this is what you have to be doing for your firms or your companies longer term, like exiting China, et cetera. And it's just it's a big struggle, I think, to figure this out. And you have to have conviction. You have to be small. And I think that's, again, one reason everyone's pulled back on position. So if we get any sort of rally, I think that can feed on itself a little bit easier than a sell-off can right now.
Yeah, especially because hedge funds have really pulled back on leverage, and you've had people really retrench with that bearish positioning that we've been talking about for quite a while. Peter, when you talk about the hard landing going forward, it's always interesting for me to hear people's worldviews and whether we're in a structurally higher inflationary regime, or, as you say, you think that the inflation story is overblown. How do we get back then to a low inflation 2% type level, especially because you're telling companies to get out of China and stop doing business there because of some of the geopolitical concerns that the generals that work for your company talk about all the time?
So I think we have to take a step back and think about the starting conditions. Where did this inflation start? It happened because people were buying two of everything, right? People were so worried about their supply chain issues, they went and bought two things. Then you looked at companies themselves. They were ordering more in their supply chains. You had all these supply chain issues. The supply chain issues are dissipating. The consumers overspent. They're slowing down. I look at autos, for example, right? You go back a year ago, every email you were getting was someone looking for your used car. Then it was like, oh, buy this used car, get a new one. Now there's new cars again. This thing has shifted rapidly. Prices are declining. People are responding to the wrong metrics of inflation, right? The Fed kept talking transitory. They got it wrong to some degree, but some of these things are going away. And look right now, all the fears for Europe, energy prices are coming down there. Oil, despite OPEC plus cuts, coming back down. There is a real problem in the economy, and that's what slows us down. And that's why, yes, I'm so bearish about a hard landing. I think we've already done too much, and we've set a chain reaction in motion that is going to lead us to real problems later this winter.
So you don't think that there's a wage price spiral in any capacity?
I don't. I think you see some great headline numbers about the wages. I think companies have still been reluctant to hire. But your last guest, I think, made a great point. So tech companies are letting go, but tech is such demand that they can find jobs. But I think as these services cuts start coming through, if that's what we're really seeing, the next step is cutting your employees. And that, to me, is a real risk. If we can't get through some of the inventory hangovers and things that we have, people are just thinking about the wrong problems. They're all worried about the situation we were facing last year. And it's a very different. And if we step back, that idea of starting conditions matter. Supply chain's gone. Consumer overspending's done. It's shifted heavily towards services overspending. But I think even that starts to go away. So January could be a little bit bleak.
Just real quick here, Peter. Do you see 0% Fed funds rates in the next 5 years?
Ooh, I don't think I see that. I think they're going to be very reluctant to ever pull back. I think they've also realized that QE is really a nuclear option, and we treated it like a pea shooter. So somehow we have to extricate ourselves from QE, and we'll be reluctant to use that. So I don't think we ever go back to this easy money, because behind the scenes, they probably will admit that it does blow bubbles, but we will see easier policy over time.
Peter Scheer of Academy Securities, thank you so much. And coming up, we're going to be speaking with Sam Zell, founder and chairman of Equity Group Investments, that is on Balance of Power, with David Weston. Right now in markets, you are seeing a bit of softness after disappointments in big tech. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. Multi-trillion-dollar industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. A lot What's happening on Wall Street?
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Live from New York City this morning. Good morning, good morning. 3 big days of gains on the S&P 500, colliding with some negative news and sending equities lower, much lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. Here comes the pain.
We're starting to see it.
Street has been bracing for some breakdown, for cracks to begin to show.
This dollar strength feeding through.
We're seeing margins that are beginning to come under pressure.
We do have higher input costs.
We're starting to see credit metrics largely peak.
We do have the geopolitical tensions.
Investors are just feeling pain. Corporate cash balances have fallen over the course of the year.
There's an argument you're starting to price in a mild recession.
Clearly the concern that we and everybody else is having is the Fed going to go too far?
We're starting to see some of those cracks come through.
We're starting to feel it.
Let's have that conversation right now with TD's Priya Misra. Troy Gaeski of FS Investments joins us too. We're starting to feel it, Priya. We saw it in the house price growth data yesterday in the United States. We saw it in the earnings after the close. How bad is this going to get?
I think pretty bad, and it's because the Fed really does not have the policy space to respond. So, I mean, I think we're just starting to see the cracks. Real rates extremely high, and you've got a Fed that's, they may be downshifting, and I think that's a communication challenge. They may downshift in terms of pace of hikes, but they're going to keep going. And so, and you've already had, QT, I think, putting upward pressure on real rates. So tighter financial conditions in an environment where the consumer has largely run through accumulated savings, I think is making up for a slowdown in consumer spending. A Fed that says, look, we told you it was going to be painful. And so, we're actually looking for a pretty deep recession starting at the end of next year, continuing into 24. And the Fed only can respond once inflation gets closer to that 2% level.
And so I think we're starting to rally in response to some of that, Priya. And I just wonder, with that in mind, how comfortable are you being long the long bond, going into everything you described?
So I think, I think the bond market's starting to wake up to it. I still think a recession is not priced into the bond market. We're pricing in 120 basis points of cuts in 2024 from a 5% terminal rate. I mean, that's still very restrictive policy being priced in. I think I like owning treasuries. I think the question is, do you own the front end because the Fed's going to respond, or do you own the long end because they're not going to respond? And I think inflation is still too high, too sticky. The Fed's worried about their inflation credibility. So I actually like owning the long end. I'm a little nervous about Bank of Japan here, but I think, if we can put, yield curve control changes a little bit in the back burner, I think owning the long end, that's really where that recession risk is going to get priced in.
On that recession risk, we caught up with Mohammed Al-Arian. Take a listen to what he had to say.
The risk of a U.S. recession is uncomfortably high. I don't like it where it is. I don't think it's a done deal. I don't think it's 100%. The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck because it no longer has time.
Troy, Mohammed says it's not 100% guaranteed. Priya's looking for it. What's a hard landing and what does it mean to you?
Yeah, so nothing's 100% in financial markets or the economy, but it's almost a certainty at this point. I mean, we've been stuck in this ugly environment all year where inflation's been simmering, obviously tighter financial conditions, and the probability of the Fed threading the needle now and guiding us to a soft landing is pretty close to zero. So, ultimately, what we're going through now is still more multiple compression, more financial condition tightening, driven not only by the front end action of the Fed, but also the historic pace of balance sheet shrinkage, which has already caused agency RMBS spreads to go to the widest in history, other than the global financial crisis. So that's going to trickle through markets. Obviously, you'll see wider spreads in credit. You'll see lower prices for equities. we're in the middle of a bear market rally right now. And then the next stop as we get into the recession is earnings obviously will decline. And that's been one of the bizarre things, John, about these bear market rallies is equity investors rooting for a Fed pivot driven by a recession.
Yeah.
And recessions are not good for earnings, right? Yeah. At that point, there'll be no more multiple compression, but clearly you'll have downside risk to earnings and you'll have a lower low being made in broader markets.
Troy, I'm with you. It's kind of bizarre. Of course, the first thing you trade on is the idea that they pause, they step down in rate hikes. I get all of that. But Priya, the second thing you trade on is working out why they're pausing, why they're slowing down rate hikes. And I don't wonderful, positive supply-side solution here. I see demand destruction on the horizon. And if Mohammed's right, if they back off because of financial instability, Priya, that's not exactly bullish either, is it?
Right, it's not bullish for the economy, and I think it's going to continue. I think they really want to tighten financial conditions, and the issue is there are going to be big lags. I think we'll all be looking at data. We'll find some high-frequency measures slowing down, but for the labor market to really tighten, and I'm a little concerned that the Fed is looking for a small rise in the unemployment rate. It might just take a while. Things could be a lot worse by the time the unemployment rate rises because we're entering a slowdown with historic tight labor market, conditions. I don't think people are waiting on the sidelines to re-enter the labor market. I think that's a structural post-COVID shift. So by the time, if the Fed's waiting for 5% unemployment rate, things could be a lot worse because I think companies will be a little reluctant to lay off people, right away because it's been hard to hire or retain people. And I think that's why looking at that one data point and inflation, both highly lagging indicators, is almost guaranteeing that the Fed's going to be late. And this idea that they can preemptively pause or preemptively ease, I think we have to put that behind us. QE is going to be not used anytime soon. I don't even think they're going to take rates down to zero. So I think it's going to be a muted, monetary policy response. I don't think you get much on the fiscal front too. So I think that financial condition tightening is going to continue and it's going to get much worse. And ultimately that does impact the economy.
Priya, Troy talked about a bear market rally. And initially I wondered whether he was talking about equities or bonds. And I know now he's talking about the stock market, but we can talk about the bond market too. A rally yesterday, yields lower. Rally today, yields lower by 5 basis points, still north of 4%. Priya, in your notes, and you've said this to me today and before as well, you talk about that 4% level, and that 4% level ultimately being a buy. Anything above 4% on 10s. What is it about that 4% level?
So there's nothing psychological about 4. There's no technical level at 4 that there's massive support. What I look at is real rates. And really, if we got to 4% because inflation expectations are rising, global growth conditions, etc., and real rates were low, maybe 4 is not that magic number. The thing is, real rates, 10-year real rates at 1.5 or higher, I think is extremely restrictive to the economy. So that's how my 4% level or something around there, I think is attractive once the market starts to get more convinced that growth is slowing. So far, we've only seen it in a few data points. I think duration has been shunned by investors because you're getting, decent return in the front end. And, people, I think, concerned about QT, et cetera, pushing longer term rates higher. But once I think you start to get more convinced that the economy is slowing, duration risk, I think, is more attractive than credit risk or convexity risk. And that's when I think people start moving out the curve. But it's really real rates that I'm watching. I don't think that the economy can handle 1.5% 10-year real rates. And you could see it in the mortgage market. I think we see it in credit destruction going forward. And ultimately, that's going to slow things down. So that's how I get to that 4%. But, anywhere 3.5 or higher, if real rates are here, I think is a buy.
Started to see some weakness in the earnings yesterday evening as well. Equity futures right now down 0.9% on the S&P 500. Disappointing results from Alphabet, ad spend, disappointing guidance from Microsoft. Katie Lyons has the story. Hey, Kaylee.
Yeah, John, if you want to see growth slowing, you can look at growth and revenue growth in the technology sector. Both Microsoft and Alphabet down more than 6% in pre-market trading after they disappointed. Texas Instruments also giving a disappointing forecast because of a deterioration in the chip space. And Seagate, a computer hardware company, down nearly 9%. It missed on the top and bottom line and announced it's cutting its workforce by about 3,000 employees, or roughly 8%. There is a theme here, John, and that theme is inflation is biting. It is eating into the demand side because customers are being more careful about what they spend, and therefore these technology companies that are also facing higher costs are having to make some very difficult decisions when they are lacking the ability to pass those input costs on. That definitely showed up in Microsoft numbers, slowest sales growth in 5 years, but as you said, it was about the forecast, specifically the Azure cloud forecast, showing corporate demand slowing in the cloud business. They also were struggling in the advertising sector, which is what Google is facing. We know that there is a slowdown in advertising because as you have higher inflation, companies are being more careful about their marketing spending. And that isn't just hitting the smaller companies in social media, it is hitting the giant. Both Google and YouTube revenue coming in short of expectations. And of course, if it's not a pretty picture for names like Alphabet and Microsoft, it's not a pretty picture for the broader market, because just those two companies make up 9.4% of the S&P 500 and nearly 18% of the NASDAQ 100. And today, it's not just they that are lower. They are taking other heavyweights like Meta, which will be reporting after the bell today, and Apple and Amazon, which are due tomorrow, down with them. Altogether, John, if the losses we're seeing in pre-market hold, we could see $300 billion worth of market value wiped off of big tech today.
Brutal yesterday evening and this morning. Katie, thank you. Alphabet, Google, down by 6.5% of the pre-market going into the opening bell. Troy, just how broad is some of the corporate weakness out there at the moment?
Yeah, well, you know, clearly in large cap tech, I mean, they were the biggest revenue drivers for years and the biggest driver of profit growth. And, you know, that's going the other way and the other way fast, right, as the consumer steps back and corporate spend step back. I mean, the early part of this year, CapEx is really strong. That's rolled over dramatically because the forward demand outlook is really poor, as you know. And then, of course, when financial conditions tighten this much, the incentive to invest and the ability to invest declines dramatically. So, you know, when you look across equities broadly, it's unlikely that we have earnings declines. Clearly this quarter, the risk is there next quarter, but really next year is where you're going to see not only declines in earnings in large cap tech, but also, you know, broader service facing industries as the consumer pulls back. Because as we were mentioning before, I mean, the U.S. consumer has single-handedly kept the global economy and the U.S. economy afloat. And as the labor markets only moved from white hot to hot and did transitions to cool, the consumption will contract. And then we're talking about that 2, maybe 3% peak to trough GDP contraction in real. You know, the only hope for equities is that nominal GDP stays positive because inflation's still relatively hot, and there isn't as much margin compression as we think there'll be. But that is like a right tail of a right tail of a right tail outcome that looks highly unlikely.
Troy, Priya mentioned credit risk. You mentioned duration risk. You focus on differentiated risk. Where on earth do you find that right now?
Well, I'll tell you, so our favorite new expression in our multi-strategy fund is a trade that was very profitable from 2009 to 12, and that was taking advantage of interest-only cash flows, which are unlike any other fixed income instrument because they have negative duration, because higher yields lead to slower refinance activity. And so right now you can buy those, take advantage of a slowdown and a decline in the housing market, because as the housing market declines, all things being equal, it's harder to refinance because you need to eject equity in your home, and very few people will do that when an asset's declining and financial conditions are tightening and they're risking losing their job. So that acts as a slowdown mechanism for prepayments. And then, you know, 3-6 months ago, you would have hedged that negative duration instrument with treasuries because agency pass-through spreads were still relatively tight. Now, given how much pass-through spreads have blown out, given the Fed's reversal of QE into QT, you know, that's the way to pick up extra yield. So, you know, we're modeling that out at like a 10 to 12% income stream. And we know there's other ways to generate an income stream like that, but this is non-correlated to broader markets. And just as important, it's negatively correlated to typically the most important asset that most individuals own, which is their home. So it's a very unique trade setup. We're not saying it's going to be nearly as profitable as 2009 to 2012, but we really like that risk-adjusted return right now, and the fact that, you know, we don't have to speculate on whether the 10 years peaked or not. We don't have to speculate on, you know, do equities bottom at 2,900 or 3,300? This is a nice cash flow stream that has low volatility and is very non-correlated.
Hey, Troy, I knew you wanted to fit something complex like that into the conversation. So that was your
Hey,
gimmick.
with you, you can handle it, right?
I tried to keep up at least. Anyway, Troy, you're going to stick with us alongside Priya. Thank you. We've talked a lot about the lack of a counter-cyclical circuit breaker in this moment in this economy because of the limited fiscal space that policymakers have right now. The monetary policy story is just to attack inflation, and they're struggling to support growth. Well, of that limited fiscal space, the Italians, the Prime Minister mulling a new aid package worth up to 10 billion euros. That story just crossed on the Bloomberg right now. Coming up, Chet Powell's message from Jackson Hole haunting lawmakers.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
The pushback, up next.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
The Fed's aggressive push fanning the flames in D.C. First came Senator Warren.
Do you know what's worse than high prices and a strong economy? It's high prices and millions of people out of work. I'm very worried that the Fed is going to tip this economy into recession.
And then came Senator Bernie Sanders.
I think they're hurting the situation. I think that it is wrong to be saying that the way we're going to deal with inflation is by lowering wages and increasing unemployment. This inflation thing is a real issue. It is a global issue. But at a time when working families are struggling and the people on top are doing phenomenally well, I don't think you go after working people.
And now, with just 1 week until the FOMC meeting and 2 weeks until the midterm, Senator Sherrod Brown with his own message for Chairman Powell, writing in a letter, "We must avoid having our short-term advances and strong labour market overwhelmed by the consequences of aggressive monetary actions to decrease inflation, especially when the Fed's actions do not address its main drivers. Don't forget your responsibility to promote maximum employment." AMH joins us now in D.C. Anne-Marie, the pressure builds.
Yeah, the pressure is building across some, we should say, that hasn't been a total Democratic Party joining this course and using the Fed as a scapegoat, but there is this pressure building, especially when you hear it from the head of the Senate Finance Committee, Sherrod Brown, just 2 weeks from the midterm elections, sending this letter to Jay Powell, talking about the fact that you have to focus on the dual mandate as well, and potentially this medicine to cure inflation may mean that there could be these gains that they've seen in the unemployment market get much worse, and they really would eclipse that. And this is the concern, Jonathan, you are seeing amongst Democratic lawmakers. Right now, of course, the Democrats are in charge of the House, the Senate, and the executive branch. And while Mohamed El-Erian told you just yesterday that it's not a done deal, there could be a recession, there is this potential slim chance the Fed could avoid it. The fact of the matter is, Bloomberg Economics, our own projections say that effectively there will be a recession in the next 12 months, and that is a huge blow for the Democratic Party and this White House.
AMH, this pushback is coming from senators. It's slowly building. How is the White House managing this message?
Well, the White House has been very clear when inflation was hit that first 40-year high, and this was a massive concern. They were trying to get gasoline prices down and communicate and message around higher consumer costs, whether it's grocery bills or rent, that it was the Fed's responsibility to tame inflation. But of course, the one thing this White House loves to pivot to is the fact that we're at a 3.5% unemployment rate, and there is a very robust, strong labor market. If the Fed is going too aggressive and you are starting to see a weakness in the labor market and you still have high inflation, it's going to be very challenging for this administration to talk about economic gains.
AMH down in D.C., Anne-Marie, thank you. As always, Priya Misra, first to you. Just how political is this tightening cycle becoming down in Washington?
So I think we're going to hear more of this all through next year. I think, heading into the 24 election, I think we'll see the political tension. Do I think the Fed is political? No. I think they're trying to do the right thing. Inflation is much too high, and that unemployment rate, they have a dual mandate, and the unemployment rate is still well below what their estimate of NAIRU is. And actually, Chair Powell has said that NAIRU might be higher than 4%. So I think until the labor market weakens significantly, I think they're going to continue hiking. I do think they can stop talking about front loading. We don't know what the threshold is. At what point do they stop front loading? And Jackson Hole, Chair Powell said basically that they'll continue front loading, but you front load with 75 basis point hikes. We just have to look at the UK. The speed of the move is an issue. So at what point do they downshift, but still talk about continuing to move, Fed funds rate higher, looking at inflation, keeping rates there for a while? I think there's a little bit of that moderation. The threshold to moderate is not that high. The threshold to cut, I think, is very high. The threshold to pause, pause the hiking cycle, I think that requires a 0.2 month-over-month inflation for a few months. So I think we all have to grapple with these different thresholds. I do think there's a moderation coming, not because of political issues, but they've front-loaded a lot. Fed funds rate is going to be at 4% at the next meeting. If they go 75, they can moderate, go 50s. And then just stay there. But I think all through next year, we'll see the economy slowing. We'll see the political talk around why doesn't the Fed cut? And I think they're going to point to still high inflation readings. So I think that tension will just stay with us for a while.
The politics hasn't come out of nowhere. Troy, we talked about that speech, that address from Chair Powell in Jackson Hole, Wyoming, for a reason. He talked about the pain they would have to cause. He also said that if we don't deal with it, it will mean even greater pain down the road, it being inflation. And Troy, the question we all asked at the time is, how does this Fed convince this country that higher unemployment is a price worth paying to get inflation down? Troy, have they done a good job of that?
Well, look, I think clearly they were way behind the curve, and we all joked around about inflation being transitory, although I don't think anyone forecasts 7 north of 8% CPI prints, just for the record. But, the reality of the situation is that inflation causes much more political pain than unemployment going up. And that was a lesson that both politicians and the Fed lost or forgot, because it had been so long since we went through that period. So whether you're a retiree, a service member of the armed forces, a teenager trying to fill their gas tank, these high inflation numbers are very painful, and unemployment is painful for a smaller subset of the labor market. And so I do think their messaging has been much more on point recently that, look, the bottom line is we have to constrain inflation. If we let it simmer and become even more entrenched in services and labor, then we're going to have to use even tougher medicine. So it's better to front load, get the pain out of the way. And look, Chairman Powell has a very tough job He's trying to balance a lot of different competing objectives right now. But ultimately, we are fairly certain they're going to do what it takes to break inflation. But of course, the price for that is extremely large, in that the next stop is a recession, where you will see a material increase in unemployment. So they have been messaging that much better now, when they moved away from the fantasy island transitory idea.
Yeah, and focusing now on pain. And Troy, you're right. How much pain? Troy Gajewski, Priya Misra, to the both of you. Thank you, as always, going into the opening bell. Equity futures are down by 8 or 9/10%. Up next, the morning calls, and later, big tech results derailing the rally. BlackRock's Jim Keenan saying the volatility ain't over yet. That conversation coming up.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
A little bit of risk aversion out there right now. 5 minutes away from the opening bell. Futures lower, down by 0.9% on the S&P, down by almost 2 on the Nasdaq 100. That's the price action. Here are your morning calls. First up, BofA downgrading Whirlpool to underperform, noting that recent channel checks point to a slowdown in demand. Oppenheimer cutting its Microsoft price target to a street low, expecting FX headwinds to continue after reporting results. And finally, Raymond James cutting its Alphabet price target to 120, expecting the challenging macro backdrop to keep a lid on near-term revenue growth. That stock is down in the pre-market by 7%. Coming up, disappointing tech results threatening to erase $300 billion in market value. The opening bell up next.
Satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
We are coming off the back of 3 big days of gains on the S&P 500. Over those 3 days, up more than 5%. Today, we collide with some negative data, negative earnings after the close yesterday. Equity futures down by 0.8% on the S&P. On the NASDAQ, tech-heavy, tech-dominated. That's where the disappointment was. The NASDAQ down by 2 full percentage points going into the bout. That was your opening bout. Switch at the board and get to the bond market. Yields look a little something like this, down by 5 or 6 basis points. Your 10-year, 4.0463%. Are those risk mitigation characteristics starting to return to the bond market? Perhaps. Priya Misra talked about anything above 4 being potentially a buy in this treasury market right now. Off the back of lower yields, we've got a weaker dollar through the whole of G10 right now. The euro positive, stronger, back with a 1 handle on euro dollar. Back above parity, euro dollar positive 0.4%, and a rally in crude. Crude right now up by 1 full percentage point, $86 and around about 10 cents. 30 seconds into this session, one stock to look at, it's Microsoft. It's down by 7.8%. Disappointing tech results, and this was the message from the C-suite over at Microsoft overnight. Our outlook has many of the trends we saw at the end of Q1 continue into Q2. Materially weaker PC demand from September will continue as the stronger US dollar decreased total company revenue by 5 points. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. This was a couple of worrying earnings prints for the market, right? What was interesting in Microsoft's case is they actually beat on the top and bottom line in the quarter. But when you look at Azure, the cloud unit, and you take into account the impacts of foreign currency exchange, the growth narrative looks a little worrying. And then the killer blow on the earnings call was from Microsoft saying that going into this current period, there'll be a deceleration in growth to the tune of 5 percentage points. That really worried the market. The narrative around Microsoft is changing. Alphabet, the parent company of Google, also interesting. It missed on the top and the bottom line. And I spoke to the CFO, Ruth Porat, immediately after the numbers hit, and she said, look, the macro environment is challenging, and it continues to look like it's going to be challenging. The dollar was also a headwind for Alphabet, but really, let's just be honest about what we're seeing. The resiliency in Google's core search business is not there. We see a weakening ad market globally, and we got signs from Alphabet that they have been hit by that. You look at where they missed expectations. YouTube in particular was wide of the mark, and what Ruth Porat told me was that they're seeing advertiser budgets being pulled back across the full spectrum of ad products in that line, both brand and direct response. So it's interesting going forward. You talked about how we've had momentum in these equity markets in recent days. We're snapping the NASDAQ 100's best streak in more than 6 weeks. You do wonder how this print actually changes the psychology of the market. We now have big questions about the global economy, but also the lingering impacts of that stronger dollar.
Well, Ed, talk to me about the ad spend. It wasn't just Google, Alphabet, it was Snap as well, and we've got Facebook a little bit later this evening.
We're painting a pretty worrying picture, right? When those Snap numbers hit, we asked the question, how transitory are these issues in the ad market? How specific are they to Snap? Then we got Alphabet, and we thought that actually the search business might hold up better. We thought that YouTube might hold up better. Remember, in YouTube's case, they're battling competition for eyeballs with TikTok. That's not what we're hearing from executives. This is pretty broad-based weakness. I pushed Porat to give me some granularity on geography, on the types of industries that are pulling back on their ad spend. Is this directly related to the consumer being hurt by inflation? They don't disclose those types of details, John, but she basically said this is a headwind, advertiser pullback, and is going to continue to be a problem.
I can tell you where that move on Microsoft 3 minutes into the session, down by 7.5%.
Yeah.
Biggest one-day drop as we close here since March 2020. Now, bear in mind that move was close to 15% lower. They were tricky times, but this is bad stuff. And Ed, I would say let's talk about the breadth as well. The IT spend guidance that you get from Microsoft, negative. The ad spend guidance you get from Alphabet, not great. And then, Ed, it was Texas Instruments as well. Can you walk us through the significance of that particular print from that company yesterday?
Yeah, what you need to know about Texas Instruments is of all the makers of semiconductors, they make the broadest amount of stuff. Their chips go into absolutely everything. And when you look at the guidance, and especially their fourth quarter revenue guidance, which was pretty significantly below expectations, the takeaway is that the end market, consumer PCs, smartphones, the weakness in demand that we're seeing is now spreading beyond those categories into the other areas that Texas Instruments provides chips for. This is broad-based. Again, it's not just specific to the high-end smartphone market or the personal computer market, which were the earlier signs we've had in this earnings season.
Ed, awesome to catch up, buddy. Thank you. Let's just leave that board up right there 4 minutes into the session. The Nasdaq down by about 2 percentage points. That's the Nasdaq 100. The Microsoft story, that weighting in that index, is a weighting of about 10% of the Nasdaq 100. That's just Microsoft alone. Microsoft down by 7.6%. Alphabet is down by 8 percentage points. And it's the breadth of this story. Ed and I just talked about it. It's ad spend at Alphabet. It's IT budgets, corporate IT budgets, showing up a little bit more negatively in the guidance of companies like Microsoft. And it's the breadth of the story, the industrial story for machinery, beyond just computers and iPhones at Texas Instruments. That stock is down by about 5.8%. The broader market right now, about 5 minutes into the session on the S&P, we're down by close to 0.6% on the S&P. You can see where the pain is if you just break it down from sector to sector. Communication services down by almost 4%. Information technology down by 2.3%. Got to talk about credit as well. Jim Keenan of BlackRock's going to join us in a second. Here's a quote from him. With consistently strong inflation prints and with economic and rate uncertainty, there's a greater downside risk to holding equities relative to credit. We're likely to see further equity market volatility. Jim, I'm pleased to say, joins us right now. So, Jim, what is it about credit that just makes you a little bit more constructive, relatively speaking?
Yeah, I think you were just touching on it. I mean, the economy is definitely cycling. So if you just start from a macro perspective, we're obviously going from, this period of excess liquidity that was put in the system during the pandemic, to now this corresponding inflation and the policy that is trying to tighten that and ultimately orchestrate this demand destruction that will probably put us into some form of negative growth into next year. And, what you're seeing right now is obviously a transition of that and a lot of volatility in the overall market. I think that's playing out in rates, FX, and certainly in equity. I think when you go to the credit markets, and just to touch on the kind of levered credit, it's certainly adjusted to the new rate regime. It's starting to cycle a little bit with regards to the level of earnings uncertainty. But for the most part, a lot of the credit markets have actually been, I would call it, came into 2022 in a much healthier position. Relative to the last couple of years, you had high growth, improving margins. You were able to lock in and extend debt at low levels. So interest coverage rates are good. Debt ratios are generally benign. And so the credit markets, I think, are fairly healthy going into this, in which case I don't think you're going to see defaults really spike up. They will creep up relative to the weaker earnings, but you're not going to see a big spike in defaults. And so the market is traded with this kind of beta or correlation to the equity market and the rate market. And I think it's, probably a little bit vulnerable as all markets are here in the next few months. But I think the next, call it 6 to 12 months are going to be really good opportunities to kind of add to broader fixed income risk, including the credit markets, when you can get 9-10% yields and have a nice income strategy into a book here.
Jim, can we just sit on that just for a couple of further questions? Because I think this is really important stuff, Jim. Can you walk me through just how much the quality has improved in the high yield index?
Yeah, I mean, if you think about 2008, right, the global financial crisis, when we went into that, there was really a credit bubble, right? You had an enormous amount of leverage getting put on these companies in senior secured fashion. And you go back there were some companies that were putting 15, 16 times leverage on a first lien basis. Since the financial crisis, I would say behavior has changed. You had the 2012 European crisis, you had 2015-16 commodity, 2018 the Fed pivot, and then you had the 2020 pandemic. So there hasn't, for most levered companies, they've been far more disciplined with regards to their overall balance sheet, right, and extending out those maturities. So, you talk about capital markets today, high yield bank loan new issuance is down probably 70 to 80% year over year, largely because they don't need to come to the market right now. Eventually they will, and they're going to incur higher levels of cost. But at the same time, they have enough room to kind of, I would call, weather earnings volatility over the next couple of years. At the same time, they've generally been deleveraging because of the health of the earnings profile from coming out of the post-pandemic. And so I would say, certainly the high yield market, you've seen this improvement of credit quality in both U.S. and Europe. You've seen a little bit more leverage getting put on the broadly syndicated loan market. But that being said, those are more senior secured assets. So we'd say expect higher defaults, but maybe a similar type of loss ratio that you'd see in that market.
And Jim, because of everything you've just said within the high yield index specifically, and this is something that Ashok Bhatia of Neuberger Berman talked to us about early this morning, the ratings profile of the high yield index has improved as well. So Jim, the question I've got, I hear a lot of people on the equity side look to credit and high yield spreads and use that as a justification to stay long equities, because the message they'll say to me is there's no red flashing light in the high yield market. And Jim, I guess what I'm asking you is, how much of a red flashing light could we ever expect from a high yield index that has improved so much in quality over the last 5 years in a way that you describe?
Yeah, and I wouldn't look to the high yield market right now for a certain level of stress. Obviously, there's a lot of things that are going on in the overall market, and unwind of some of the kind of the QE trades that have been in place that are causing a lot of volatility in broader markets. I would say more so in FX and rates than you are seeing in the high yield market. I would say, if you really look at it, the market is cycling lower, but you don't have this kind of broader shock that is causing a kind of a significant immediate decline in consumption trends. I think that is going to occur over the course of the next couple of years. When you think about from an equity perspective, we have come from an environment where you've had, in quantitative easing, very low rates, very low volatility. And so from every dollar of earnings growth or of revenue growth that you've seen, the free cash flow conversion was very, very high because of the operational margins that you were able to incur after the pandemic, and with regards to the low rates. I think that's all going to change. And you think about the next several years, companies are going to cycle, and so inflation is likely to break, but it's the rate of inflation that's going to break, in which case cost of goods sold or input costs, labor costs, and the actual cost of capital is going to increase. And so that free cash flow conversion for companies is going to be a lot lower for the next 10 years than it was the last 10 years. And so credit is actually a pretty good asset. I think the equity market obviously has to readjust to that level of growth, but also what that means from a free cash flow perspective. And I don't think that's an immediate change, but I think that evolves over the course of the next couple of years. And in my view, that warrants a higher risk premium or a lower PE multiple. And so I think that is something that is, again, going to make credit attractive relative to the equity markets over the course of the next several years.
Hey, Jim, awesome. As always, Jim Keenan there of BlackRock on the latest breakdown in this credit market. There's a real breakdown in this equity market on the S&P 500, lower on the NASDAQ, much more so. Let's get you some stock movers. Just after the open, about 11 minutes into this. Let's get to Abby right now. Morning, Abby.
Morning, John. Well, it's really pretty interesting because, as you were highlighting, we have this big divergence between the S&P 500 right now down about 0.5%, that tech-heavy NASDAQ down about 2%. This has everything to do with techs getting clobbered, but there are other stocks, and they are working on earnings. Halliburton up about 2.2%. Their earnings doubled on a year-over-year basis. This, of course, on high oil prices. Harley-Davidson soaring up 6.7%. They beat on lowered expectations. NVIDIA is saying that they have better profitability. handling inflation so well so far. Kraft Heinz had been higher. They beat. They were helped out by price hikes. And similar to Chipotle, they beat on price hikes, which offset lower transaction volume. But now both of those stocks are down, probably some fears about profit margins. In fact, if we go into the Bloomberg terminal, we will see that that is the story, because right now sales for the second quarter, or the third quarter, excuse me, up 10.6%, with about a third of the companies in the S&P 500 having reported. Earnings, though, right now down about 1.6%. Profit margins in yellow, shrinking. So that's the worry, that we are entering some sort of an earnings recession, either this quarter or next quarter into next year. But because there are some companies that are handling inflation well and price hikes, consumer staples, one of the sectors doing well in the morning. Healthcare, regional banks doing well, up about 4% over the last week. They, of course, benefit from rising rates. And then oil services, again, pointing out Halliburton and Baker Hughes recently said that the supply issue constraints are over. So positive trend there.
Abby, thank you. About 13 minutes in, we're down 0.75% on the S&P. On the Nasdaq, we're down by 1.8%. Coming up on this program, Elon Musk pledging a done deal by Friday.
Twitter, under the next, probably call it 6 to 12 months under Musk umbrella, is going to have a lot of volatility. So yeah, that is going to add to probably some market share loss.
That conversation up next.
Politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
when it comes to retaining talent, and it's very costly here in Silicon Valley. So I think that's going to be challenging for Twitter. There are still a lot of private companies that are doing a lot of innovative work, and Twitter, under the next probably call it 6 to 12 months under Musk umbrella, is going to have a lot of volatility. So yeah, that is going to add to probably some market share loss.
Elon Musk pledging to close his Twitter deal by Friday. Bloomberg reporting he made the announcement on a call with bankers providing $13 billion of debt financing. Twitter shares jumping on the news and drifting towards Musk's offer price. The team coverage starts right now with Bloomberg's Ed Ludlow on the West Coast and right here in New York City alongside me, Sonali Basak. Ed, first to you, is this actually going to close on Friday?
All signs are that it's actually going to close on Friday. I mean, the main line of the reporting, right, is that Elon Musk hosts this video call according to sources. But for me, the more important detail is sources also say that the borrowing notice probably went to from Musk to the banks Tuesday. The money goes into escrow Thursday. And both sides, as we'd always reported, have been working diligently to that deadline. I think what's interesting is sources tell me that on the equity side as well, investors in the new entity, whether they are rolling over their public market investment or they're buying in for the first time, have also been notified by Musk's lawyers that the intention is to close by 5 p.m. on Friday. You look at the stock, we're at $53 a share, John, for what it's worth, slightly academic, highest level since November of last year. But what I'm talking about, of course, is the spread. And we've looked at that spread kind of flutter around. We're the closest towards zero that we've been at any point throughout this saga. So the mechanics are there, the signals from both sides are there, but really the signal from the market is the strongest that it's been since we've been covering this, that, right, we think it's going to get done.
Sonali, I think you've got the main story. It's the banks. And typically I'd say to you, how much are they going to earn from this deal, Sonali? And this time we're talking about how much could they lose?
It's very true. You see them mark down a lot of mark-to-market losses earlier in the year, so it's very hard to tell how much they're going to take in addition to that. We didn't see serious markdowns among these large banks in the most recent quarter that they reported. But listen, the estimate that we have over at Bloomberg, minus the fees, is about $500 million across the banks. The estimates across the buy side and the sell side range much higher than that, sometimes 3 times as high as that. It's going to depend on what they can offload this debt at, who will be the buyers of this debt. I think one fun fact here is that Musk is committed to helping court investors for some of this debt up to 30 days after the deal closing. Boy, would I love to be a fly on that wall. You have Musk agreeing to participate for as much as 2 hours in those conversations, in those meetings. So sitting with Elon Musk for 2 hours and talking about the cost of financing about a risky deal like this should be super interesting. John, I have to say one more thing interesting that's happening across the sell side here. At least 3 different banks have kind of bragged or, you know, touted or highlighted to me that they've skipped the deal. For a reason here. The reason being is now you have banks on the sell side with $40 billion worth of commitments that they've financed this year from their own books. And the bigger issue here is that overhang that's going to create into next year. The banks that have not committed to this deal are interesting because they're saying that they have more dry powder into next year. So the question then becomes, what is the level of buying here when triple Cs are edging up to 16%?
And what were they promising? A limit, a cap of interest? 11.75. Ridiculous. And Sonali, to your point, it's not just a Twitter story. It's been a big, big story of the year so far. And what Sonali said there that I think was more interesting was that Ed Ludlow, you're going to see Elon Musk on that call. Elon Musk is going to be on that call speaking to investors for maybe 2 hours, and he's going to have to tell them what he wants to do with this business. Do we know that answer yet?
We have an idea of the answer. It's X, right? It's the everything app. Just one point to what Sonali said from that story. You know, according to sources, Musk is offering to help the banks market the debt because, of course, they've got to front the cash but then go to the street and sell it, right? And I thought that was a really interesting line that Musk is saying, don't worry, I'll help you with this exercise. Look, there's lots of reporting about what he'll do. The main thing is that he wants to streamline this company. He wants to make it more than just a place for sending tweets, you know, something modeled after a WeChat or something like that out of Asia. Interesting for me as well, the report that he'd lay off 75% of staff. I think that he won't be afraid to make changes, but we still don't have a clue whether he goes there and becomes CEO or whether he installs a close ally to lead that company. That will also be interesting because don't forget about the key man risk element that the market has when it comes to Tesla stock.
Hey Ed, awesome as always. Ed Ludlow on the West Coast, Sonali Basak right here in New York City. covering the Wall Street angle of this. What are we, 22 minutes into this? Equities down 0.6% on the S&P, on the Nasdaq down by 1.5 with a sector price action. Back with us, here's Abby.
Hey, John. Well, we are looking at the first down day for the S&P 500, as you know, in 4 days. The big question is whether it will stick. Now, if we take a look at the sector action, because of the huge weighting of the mega cap tech indexes, sectors, communication services, tech, and then discretionary, there is reason to think that we may, on those weak results out of Alphabet and Microsoft, because that is the big weighting to the index. You can see the rest of the sectors are actually higher. Healthcare, energy, financials, all up, along with materials and utilities. So again, it's going to be an interesting battle on the day between the sectors that are working, most of the index, in fact, versus those heavyweights. Now, the point I want to make, though, over the last 5 days, this is a piece of the bear market rally everybody's talking about. The S&P 500, even with today, up about 3.7%. All 11 sectors are higher over this time period. The best happen to be healthcare, materials, along with financials. Stay tuned, John. Never a dull day here.
Never a dull day. Not in this market, not in this cycle, and not in 2022. Abby, thank you. 23 minutes into this, equities lower, bonds up, yields are heading south, and this dollar is a whole lot weaker. Up next on this program, your trading diary.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
25 minutes into the session, equities lower, negative 0.7% on the S&P, now down by about 0.6%, off by 1.8% on the Nasdaq this morning. About 25 minutes in, that's the price action. Let's get you the trading diary. What a 24 hours we've got coming up for you. New home sales at the top of the hour. You'll hear from the president discussing U.S. inflation at 10:30 Eastern time. Meta earnings after the close. Then Thursday looks like this. Amazon and Apple earnings after the close. A host of economic data, including jobless claims, U.S. GDP, and an ECB rate decision in the mix as well. Then we'll get a Bank of Japan decision on Friday, and we close out the week with U.S. personal income and spending numbers, core PCE, and the UMich Consumer Sentiment Survey. Is that enough for you for the next couple of days? From New York, thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that They're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable. Some days it's around 1, and other times it'll drop down to about
0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed Harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the